Cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
Good morning. Here are your top stories. Not impossible. The ECB's Class Knott says the central bank could hike rates as soon as October. Global yields surge as bumper US jobs numbers fuel hike expectations. Bolstering the border, the US and France discuss how to strengthen Europe's eastern flank as Macron heads to Moscow. Plus, we'll speak exclusively to the head of Italy's largest bank. That conversation with Intesa Sanpaolo CEO Carlo Messina in around 30 minutes' time.
Tom, let's take a look at the futures. It's very clear that there's a Chinese rally after a week-long holiday. They're now playing catch-up to some of the technology stocks over there, gaining here in Europe, taking in their stride the fact that monetary policy will be tightening. We have to look at all the nuances with the ECB, but for the moment, we're seeing markets open higher.
We are indeed. It's another big week as well for data as well to kind of clarify that picture, Francine, amid all this uncertainty around the central banks, particularly from the ECB. We're going to hear from Christine Lagarde, who's going to give some statements in the European Parliament later today. You've got the CPI out of the US, of course, crucial in terms of forming the views around the rate hike policy and just how quickly and how hard the Fed goes. That'll be later this week as well. China is back, and we've got gains across the mainland. Just to what extent that can be sustained, though, amid continued concerns about the health of the economy there. Here in Europe, then, after a week when we ended flatter or lower, in fact, for the European session, across the week, last week was red. The US, by the way, on Friday, just to recap, ended in the green. The Nasdaq 100 up about 1%, the S&P 500 up about 0.5%. Both indexes flat for the week. Here in Europe, and to start the week on this Monday, the Spanish IBEX is gaining 0.6%. The CAC Cajon is up by 42 points, and the FTSE 100 is up by 0.3%. We had an industrial data out of Germany as well that came in below some of the forecasts. Italy is gaining 0.4%. Let's switch it on and look at how things are playing out across some of the other asset classes. Again, as markets continue to reprice around what we've been hearing from the ECB and the BOE. 135 on sterling, euro dollar is at 114, and the two-year yield on the German Bund is currently negative 2 basis points. You have seen 9 consecutive sessions where these yields have been edging higher. Do we get into positive territory before the first half in the session? We'll continue to keep an eye on the German two-year. Italian two-year is currently up 0.3, so a little gain there in terms of 3 basis points for the two-year. A bare flattening is what we're seeing across the Italian yield space. Let's switch on and have a look at how things are playing out. As we look ahead to the US session, again, it's the CPI data midweek that we're going to be focused on, particularly for the States. The S&P futures gaining just 0.1% after posting gains on the back of that very solid jobs number on Friday. The US 10-year yield now at 190. And by the way, the two-year yield is around 120 as well. $93 on your Brent. You've got some views that Vitol, this is from Vitol, that China is going to be increasing their demand, which could prove supportive. $93 in terms of what you're seeing. Brent now down 0.1%. And by the way, Bitcoin back to $42,000 per coin. That's sneaked up on us slightly. It's currently up 2.5%. So Bitcoin is back above 42,000. Francine.
Yeah, I have to say, Tom, that interview with the key Vital. Actually, he's head of Asia, was key to understanding the markets. We also have an energy special. We'll be speaking to Jeff Curry of Goldman Sachs. And really, the million-dollar question is, he's predicting oil prices to go to 100. When does that happen? Energy today, actually one of the weakest, so pretty much flat. We are seeing a little bit of support for financials leading up to the gains, some 0.9% higher. Tech also 0.9% higher. And of course, when it comes to financials, Tom, it's all about the ECB. Three main questions we need to ask. First of all, is the path, the trajectory that market is pricing in for ECB tightening the right one? What does it mean for sequencing? And are we going to look at a mistake? We know that Klaus Knot, one of the biggest hawks on the governing council, doesn't think so. But a lot of other participants, including big banks, think that this could be a mistake if they hike this year.
It could be beneficial, of course, to the banking sector. We all know this. Intesa Sanpaolo, we're going to be speaking to the CEO later this hour. Intesa Sanpaolo currently up 1% after promising and beating with their earnings on Friday and promising to return about 22 billion euros to shareholders. Rio Tinto in focus for us, the mining space on the back of some views that there's a tighter supply and strong demand out of China, currently gaining 1%. And Reckitt Benckiser, some reporting from Bloomberg that was pushing the stock up by about 0.7%, that they're looking to spin off their baby nutrition part of the business. Jeffrey said it would be positive. It might be difficult to spin off, but Jeffrey's saying if they did manage to do that, that would be positive for the stock. Let's switch it on in terms of the charts that we're looking at. We are talking, of course, about the ECB because there's so much in terms of the transparency that is lacking here because of the views and the way and just how quickly they have shifted. The statement was bland, but of course it was the hawkish commentary from Christine Lagarde. And the key question for me, Francine, is what this means for those sovereign yields, the yields of Italy, Spain, and Greece, of course. If you do get a more hawkish stance, if they start to hike, as Klaus Knot suggested, possibly in the fourth quarter, do those yields start to blow out? And what kind of problem does that pose then for the governments of those nations? This chart really shows what is happening in terms of the spread tick up for those sovereigns.
Yeah, and the concern, Tom, is that it's not only about fragmentation in the Eurozone, because it is where the spreads need to be closest just to make sure that countries don't go after each other. But there also seems to be a lot of fragmentation at the ECB Governing Council mode, because we heard from Christine Lagarde and also Isabel Schnabel, the chief economist Philip Lane, saying, look, for the moment, we're not worried too much about inflation. Then there was a clear pivot with the influence from the hawks at the Q&A session on Thursday. So that could play out on the markets. It could get a lot more ugly than we have for the moment. Now, one person who's very sensitive, of course, to some of the spreads because they hold so much Italian bonds, Carlo Messina, the chief executive of Intesa Sanpaolo. It's a key interview coming up later this hour. We'll be speaking to Italy's largest bank. That conversation will be exclusive and in just about 20 minutes from now. Now, let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Peloton is reported to be evaluating potential takeover options after its share plunge made it a target for acquisition. Reports in the Wall Street Journal and Financial Times suggest Amazon and Nike could be among potential suitors. That saw shares surge in after-hours trade. Olympus shares have tumbled in Tokyo after it kept its full-year operating profit forecast unchanged at $1.25 billion. Earlier, the company's COO told Bloomberg exclusively about how Olympus is navigating uncertainties brought by the pandemic and global supply chain issues.
I think we need to be a little bit more creative in the way we plan our supply chain, and accept that we're going to have to deal with certain uncertainties. This doesn't mean that we're not going to make it. It means simply that we're going to have to be more open and try different things. I mean, in our supply chain, we are making changes.
Sitcom Friends is returning to China nearly 20 years after its final episode was produced. The show will be available from this week on platforms including Tencent. The release is notable given China's growing restrictions on American entertainment. That's the Bloomberg Business Flash. Francine.
Thank you so much, Laura Wright in London. Now let's get into the key market drivers with our markets editor Christina Aquino and Esti Dweck, Chief Investment Officer at Flowbank. So thank you both for joining us. This is going to be the week where we suddenly think back about what the ECB said and try to see what kind of pressure it puts on the markets. Christine, I know our Valerie was bringing our attention to the fact that Italian bonds are opening up weaker, led by the 2-year. And again, it's just a readjustment trying to figure out how many hikes there are this year and possibly into next year.
Absolutely, Francine. I think now is really the time for soul searching in bond markets in Europe in particular, especially in reaction to what we saw from the ECB last week. I mean, some of the immediate pricing adjustments that we saw at the tail end of last week was definitely in money markets, where we're now seeing the possibility of a summer rate hike for the ECB to kick off the 10 basis points starting gun, if you will, for this tightening cycle or potential tightening cycle that markets are seeing them embarking on now. And of course, that is probably going to get juiced up as well by comments from ECB's not over the weekend. And yeah, I think the key question is, how does the rest of the Governing Council think about all of this? I mean, we definitely got an indication from them last week that they're not ruling out rate hikes anymore. But that's another discussion from the timing of when they might see it getting delivered. Is it still a 2023 prospect, or is that out of the window, or and is it something that we could see in the first half of this year, or still toward the latter half of 2022?
So, Christine, that's the rate hike conversation. What about the end of bond buying and what that could mean for the Eurozone, particularly those peripherals that we discussed at the top of the show?
Absolutely, Tom. I mean, that does have very, very big implications for their bond buying program as well, because as we know, the ECB is all about sequencing, right? They've said time and again, it's not going to be, they're going to deliver those rate hikes only after they've concluded their asset purchases. And so I think that significantly speeds up the timeline on signaling the fate of the asset purchase program as well. And they could be cornered into indicating something as early as the next couple of months.
Esty, what's your take on what we heard from the ECB? So we see those credit spreads widening, and there was a rambunctious debate actually at the weekend on whether the unorthodox way that we could see sequencing in the ECB is the wrong way to do it. I mean, we now have the benchmark that is the Fed, but is that the right one?
It's a very different question, I think, for the Eurozone, because they've had trouble getting inflation higher for a long time, and they've had trouble keeping growth higher. When you think about trend growth for the Eurozone, you're at 1.5%. So 2022 might be a tricky year from an inflation perspective, but if they're looking further out, they don't want to over-tighten. And they also have very specific priorities. As you were mentioning, there's the sovereign question. They don't want these spreads with Italy, with Spain, with Greece, with Portugal to widen too much, and I'd say with Italy in particular. And they're also very, very focused on this energy transition, and they also need to keep borrowing costs relatively low to help with this transition, and of course help the financial sector. So it's a different position that the ECB is in. I think they don't know what they want to do. They know that they have to keep their options open. They know that they might have to be more flexible. And locking themselves in with a 2022 hike is very improbable, is not the right commentary anymore. The same way the Fed had to move away from the word transitory because they were locking themselves in. So it's about opening the door and opening options. It doesn't mean that hikes are going to be imminent. And I think somewhere the ECB is going to have to find a way to keep something going on the balance sheet, even if it brings rates back closer to zero.
Yeah, the generous way of looking at it is they're leaving themselves optionality. The other way of looking at it is they just don't know what they're doing. When it comes to the Fed, did the jobs numbers, those blast out, those incredible job numbers, blowout job numbers, I should say, did they change your view? Did they crystallize what you expect to see from the Federal Reserve in terms of the wage growth that we've seen, the participation rate? Does it just make that picture in the US clearer now?
I think it confirms what we already knew, that it's one less obstacle to the March hike, which is basically guaranteed and priced in at this point. It doesn't necessarily tell you what they're going to do in the second half of the year. I think expectations had been for such a soft print that the upside surprise was even bigger than expected. The Fed it knows it has to react sooner, and the market has now priced that in. It's going to give them a couple of hikes for sure in the first half of the year. The second half picture, I don't think is much clearer, and certainly not around one jobs number where we knew already that the economy and the labor market was doing a little bit better. So I think that second half is still going to be a question mark, and the market is really pricing in a lot of hikes already.
Yeah, and when you look at what the ECB, statements, or certainly the QE brought, Christine, there's a huge, repricing also of European stocks, or certainly banks that could be a lot more supported by some of these higher interest rates. I know if you leave the question of sequencing to one side, I mean, you could argue that it's actually only the Fed and the BOE, though, that are behind the curve, so that the ECB may be a bit confused in their messaging, but at the moment, we're not looking at a policy mistake yet.
Yeah, I think the conversation of policy mistakes is still a little bit further off. I think because, yeah, the concept of tightening for the ECB really came through as a bit of a surprise from last week's aftermath. And so now we're still kind of in this discussion of what does this actually mean? Is this a big regime change for the ECB and the implications, of course, for the equity market in Europe? And you're absolutely right, Francine. I think this is definitely likely to be a boon for banks in particular for their interest income, because this region in particular has been just has just been weighed down by an era of low policy rates for such a long time.
Which is a great chart that we actually have looking at, European banks, how they performed less well than, everything else, the Eurostoxx 600.
Just been swamped by that liquidity from the ECB for so long. The negative rates as well, negative yielding debt. We've seen that fall off, 1.5 trillion in just a single day. So as that starts to change, JP Morgan as well coming up with a call saying that globally you're going to see rates at about 2% by the end of the year. So the benefits for the financial sector, but the challenges at the government level, particularly around the peripheries. Christine Aquino, thank you for breaking down some of the key themes across these markets this Monday morning. Esti Dweck, Chief Investment Officer at Flowbank, stays with us. We'll be talking China and EM next. And coming up, the world's second biggest economy, as I mentioned, cranking back into gear after Lunar New Year. But latest figures suggest that Chinese activity is slowing down. We dive into the numbers next, the implications. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Welcome back to the Open, everyone. 16 minutes into European trading day, and you can see the European stock 600 gaining some 0.4%. More of the focus should probably be on bonds, with the global bond rout extending on Monday. We also have a widening gap, yield gap between Italy and Germany, the worst since July 2020. We'll see how it plays out, but certainly the hawks at the ECB seem to be more in charge, having a say, with Classic Note also saying he's expecting 1 hike this year and 1 in early 2023.
Yeah, so amid these changes here in Europe, the UK and the US, do you look to China for some shelter? China stocks have been playing catch-up as the country returns from the Lunar New Year holiday. On the economic front, PMI data this morning shows the recovery in both services and manufacturing is weakening. Esti Dweck, Chief Investment Officer at Flowbank, is still with us. Esti, I want to pull up a quote from Hao Hong at BOCOM, who's a strategist that many people watch. He's called the Chinese markets, mainland markets, correctly a number of times in his career. He says now is not the time to chase this rally in Chinese A shares. Do you agree, or is there an opportunity here?
I think a lot of it is going to depend on your investment horizon. If you're thinking medium to long term, we've had attractive entry points for a number of months now, and it does feel a little bit like the worst of the crackdown is behind us. It's probably not completely over, and that uncertainty overhang is going to stay. But you start to have a little bit more confidence about the longer term, and you're also getting a bit of confidence that the government and policymakers want to stabilize growth. They don't want to let it weaken much more from here. And that probably means we get a little bit more easing over the coming months, and I think that's going to prove supportive for markets. But whether it's a short-term up and we'll have more volatility, or whether this is the beginning of the recovery, I think it's too early to tell.
I know, Esti, there's a lot of the Chinese stocks today being supported, and it is not just because of the end of Lunar New Year. I know Tom and I both ate our weight in Chinese food in the last 5 days, but actually the focus is really on some of the correlation between Chinese stocks and U.S. peers that, until now has been quite strong. Or we see that weakening and continue to weaken as we get into 2023.
I think we are going to see a divergence between the different regions. You're really starting to see China have its own drivers. One of them obviously is regulation. It's any rules that might come. You're going to have the policy easing as opposed to the policy tightening. In the rest of the world, you have the growth dynamics, again, that are different, hoping for a stabilization, if not a reacceleration, and all of that with that deleveraging of the property sector. So it's a tricky proposition from China, but a couple of big divergences now compared to U.S. peers or global peers, and I think that's going to materialize in some of the performance, although I do see upside for both of those for 2022.
Esti, before we let you go, you've long touted the view that having the barbell approach is appropriate in the current environment. Is anything, so cyclicals on one side, tech on the other, has anything that you've seen within the tech sector shaken your faith in that barbell approach?
I think you have to become even more discerning within the tech sector, but the same applies, I think, to a lot of other sectors where you're seeing maybe the sectors or the subsectors have more of an impact, or individual stocks. In the last few weeks, we've seen that earnings across a lot of these big tech companies had a very big impact on the performance, and we could see some huge diverging moves between a couple of names depending on how the earnings results were perceived and how the guidance was perceived. So you might have to be, maybe more of a stock pickers market coming in a couple of months. But generally speaking, I do still think that tech is going to hold up and do quite well in 2022.
All right, Esti, thank you so much. Esti Dweck, there, Chief Investment Officer at Flowbank. I have to say, it's probably my chart of the day. I feel bad because I know that all of the focus is on repricing, especially in bond yields with the ECB, but I love this chart because it really looks at the market decoupling, and it goes back to the fact that, the correlation between so-called A shares really goes to policy monetary divergence between Beijing and Washington. So we could see that deepen quite significantly.
This is really intriguing, isn't it? And whether you want to have more exposure to H shares, the valuations there, many would argue, are looking compelling, but it's the regulatory side as well. Yeah. And the analysts that we speak to say, look, we're far from over when it comes to the changes around the regulatory front this year out of China.
I mean, I don't feel bad for regulators. That's just not what you do. But they've tried so hard, right, to actually support investors. And a lot of the efforts have just been in vain. Yeah, this is true. No empathy there for the regulators from Francine Lacroix. There you go. You have it on the record. Coming up, Nike and Amazon. This is a great story. Reportedly weigh their own bids for Peloton. But the regulatory headache, talking regulators, may lie in wait. That story is next. The details. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City.
Here in London,
In Sydney.
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics? The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Welcome back to the Open. We are 24 minutes into the European trading day, and a reminder that these markets have continued to price in the action we saw from the ECB, the BOA, and of course that jobs number on Friday, just crystallizing the case that you're going to get that hike in March from the Fed, more than 5 now priced in, but the clarity or lack of clarity around the ECB, given the statement and then the commentary from Christine Lagarde, and that's been reflected in the bond markets this morning then as we continue this repricing. So you can see the Italian 10-year, just to recap, by the way, the US 10-year at 191 and the 2-year over in the US at 131. But here in Europe, the Italian 10-year, 180. The Portuguese 10-year above 1 now, up by close to 4 basis points. A 3 basis point increase for Spain and a 5 basis point increase for Greece. 232 for your Greek 10-year. 6 basis point move over in Italy. So that repricing continues, Francine.
Yeah, and the global rout is deepening. Now, after a brutal fall in share price, Peloton evaluating potential takeover bids. That's according to media reports. The home fitness company was once, well, one of the pandemic success stories, but investors have questions about the long-term growth pictures as economies reopen. Well, joining us now is Bloomberg's Laura Wright. Laura, what I love about this story is also every major media outlet has a name that could be interested in Peloton. So the Wall Street Journal thinks it's Amazon. The Financial Times thinks it's Nike, and it could even be Apple to take over.
Well, yeah, Dan Ives from Wedbush, a well-known tech analyst, he thinks that Apple could be a contender for both offensive and defensive reasons. Look, they're growing their wearables business. A defensive reason could be to just stop another player getting ahead. Peloton has fallen 80% from its peak a year ago. And if you look at a share price chart over 2 years, it resembles an inverted V. For Amazon, they've got the Halo division, which they've launched with wearables. Nike, the Nike Training Club app. But for all companies, it's really a way to bring those 2.8 million subscribers that Peloton has onto their own platform as a vehicle for their other products. And look, we'll see how Peloton reacts in the pre-market later this morning. And analysts will be listening very carefully on the earnings call after market tomorrow about whether we get any hint of this potential takeover.
Okay, Laura Wright breaking down the Peloton story. We'll keep across that one for you in the days ahead, of course. Coming up, Italy's biggest bank, Intesa Sanpaolo, plans to return more than 22 billion euros to shareholders. We'll speak to the CEO. This is Bloomberg.
The end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. ECB action. Classic Note says the central bank could hike rates as soon as October. Global yields surge as bumper U.S. job numbers fuel hike expectations. Bolstering the border while the U.S. and France discuss how to strengthen Europe's eastern flank as Macron heads to Moscow. Plus, we'll speak exclusively to the head of Italy's largest bank, the conversation with the Intesa Sanpaolo chief executive, Carlo Messina, in just a few minutes from now. His views on their new business plan, but also the outlook for the European banking sector. So, Tom, when you look at the markets, there's definitely a widening of spreads between Germany and a lot of the periphery. Coupled into that, though, China's back. It means business, technology up, and it's giving a nice little lift to European stocks.
Well, certainly the market's action, and we certainly saw in the mainland, upside of more than 1% for the CSI 300, just catching up then after that Lunar New Year break. And a focus on whether or not you get more supportive measures and to what extent they drain liquidity, as they traditionally do after Lunar New Year. You're range bound here in Europe, though. The Stock 600 really treading water, maybe looking for the next catalyst after all the central bank action of last week. And just a reminder, because of the context, last week you ended in the red for European equities. US equities are flatlining, really, for the week. We're looking ahead, of course, that big CPI print from the US on Thursday. North of 7% is the expectation, and as a guidepost for the market. In terms of what we're seeing in Germany, gains of 22 points, so just over 0.1%. You're flat on the CAC Quarante, just up by 1 point. The FTSE 100 is also flat. A bit of a drag there from the energy complex. We'll take a look how things are playing out then, sector by sector. Just a reminder as well, JP Morgan are now predicting that globally, global rates are going to be around 2% by the end of this year. So reconfiguring to that. And really, Francine was saying, you're seeing more action in the bond markets today than you are in the equity markets, with that sell-off across the sovereigns continuing across the Eurozone. Retail is gaining 0.8%. Basic resources is up 0.5%. And insurance also posting gains, modest gains of 0.4%. And the bottom of the list, you've got energy, as I mentioned, down 0.6%. Still, Brent is around $92, $93 a barrel. Real estate is also lower by 0.4. So that is the sector breakdown, 30 minutes into the trading session here in Europe this Monday. We also want to look at what's happening in the banking sector. We've got an important interview just seconds away with one of the biggest lenders in the European space. But let's switch it on and see what the chart is telling us about the differentiation between some of these lenders in the Eurozone and how we adjust to the prospects of higher rates, and whether that is, and to what extent that is going to be further supportive of these lenders. And you can see the breakdown between Intesa, UniCredit, and the European stocks sector. That is the yellow line, but it's Intesa that has outperformed over the last 5 years. Francine?
Yeah, I like that chart. First of all, because it shows also the correlation between some of the bonds longer term, certainly because they hold a lot of the Italian bonds, but also it shows the Intesa outperformance since we've had a stable chief executive at the top that so far has actually stuck to what he's promised. I think I saw 3 banks say that they were rating the bank buy. Intesa Sanpaolo, as Tom was saying, says it plans to also disperse more than 22 billion euros to shareholders in the period to 2025. Now, Italy's largest bank plans to pay out 70% of annual earnings to stockholders through cash dividends. This, as Intesa reported, better than expected quarterly earnings. Well, I'm very pleased to welcome the chief executive of Intesa Sanpaolo, Carlo Messina, who joins us for an exclusive conversation. Carlo, as always, thank you so much for joining us. Now, when it comes to your earnings, you actually said that you were quite conservative or that you could outperform your own forecast. What's hinged on that?
Yes, Francine, we have considered in the business plan an interest rate environment in which we could continue to have minus 50 basis points Euribor. In reality, it is clear that it is really conservative. If you consider moving from minus 50 basis points to 50 basis points, so 0 Euribor rate, we will have a net income well above 7 billion euros in 2025. So there's a sensitivity to interest rate that is really conservative in our business plan. Then also on cost and provision, we were really conservative. And it is the typical way in which we prepare the business plan and we over-deliver on our promises.
So, Carlo, talk to me a little bit about what the market is expecting right now. And this is without a doubt the story of the day, the repricing in Italian bond yields. Now, we also heard from Klaas Knot, probably one of the most hawkish hawks when it comes to the European Governing Council, but he's not quite pricing in what the market is saying. So the market is betting on a 25 basis point hike in September. Klaas Knot says wait for the fourth quarter. What's your take on when they'll hike? And is this the reason that you'll be able to lift profit targets and dividends?
So that's for sure an environment in which now we will enter into a phase of interest rate increase. Probably in Europe, this will happen in the end of 2022. I'm not so bullish on short-term repricing, but my idea is that for the end of 2022, also ECB will enter into increase of interest rate. At the same time, there is an increase in the yield, but looking at fundamental, in my view, there is an underestimate of the potential of the Italian real economy to rebound in GDP also in this year and the next years, because if you consider that in the last year and a half, we had an increase in deposits from retail clients and corporate clients for an amount that is 260 billion euros. So it is roughly 50% of the GDP of the country. If this money will come back to real economy, there will be another significant growth of GDP that can be added on the next generation EU funds.
But
Yes.
Now, Mr. Messina, are you worried actually that higher interest rates is a good thing for banks, especially Italian banks, but are you worried that if the spread widens with Germany, then investors will get nervous once again about investing in Italy?
No, I don't think so. I think that at the end there could be much higher opportunity because this extra yield will be something not correlated to the risk profile of the country. And at the end, this will bring extra opportunity of taking profit because I think that the real economy condition in the country is much better than a significant number of other European countries, also in the so-called core Europe. So at the end, if you look at fundamentals, the engine for growth in the country today are really significant. So I'm not worried at all. Looking at banking sector, it is clear that is a unique opportunity because at the end, in case of an increase of 50 basis points or also 1% basis points, you will not have a deterioration of quality of credit. At the same time, you will have an increase in net interest income that will be significant.
Mr. Messina, I mean, one of the things that actually a lot of analysts are trying to figure out is you had banks saying that, there's a lot of optionality, that your results were very strong and therefore they have a buy recommendation. You also dished out Europe's biggest bank payout plan, and yet shares and shareholders were not that excited. What do you think is going on?
Francine, it is typical of the leader in the market. So you have always to over-deliver on expectation. But when you prepare a business plan, and you remember, then we had the first meeting when I was appointed CEO in Davos a lot of years ago, and I was promising that the bank can transform into a wealth management protection company. Investors look, an Italian can become a leader in Europe. Then at the end, we delivered. So now the plan is based on conservative assumption, moving from wealth management, protection, and advisory into a technological company, because for the retail and mass market, we want to become a real fintech. So trying to move from an ordinary model into a fintech model, and we will deliver on our promises. But the price to book is so high that our market cap is really a good news for all our investors.
Mr. Messina, I know you've ruled out transformational deals. So how do you increase your footprint in Europe?
So the starting point, as I told you, on fintech and the threats of the fintech in the environment. If you look at retail mass market, the value of retail branches will move into zero. So there will be no significant possibility to create value making a transformational deal with the big retail players. You know that wealth management and protection are the areas in which we can consider opportunity in the market, especially private banking and asset under management. But the prices that are embedded in the targets are so high that there will be no possibility to create value. At the same time, during the plan, we think to realize an increase of 100 billion euros of asset under management working with our network. So we'll be really committed to deliver the plan without any kind of acquisition.
Carlo, is your presence in Russia a source of concern? Do you see it actually, how do you see that developing?
So, Francine, we are in Russia because we think that Italian clients need to have a support in Russia. Russia is a country in which we are generating net income. We are not a geopolitical player. We will respect all the European and international rule, but geopolitical is another game. So we are obliged to respect all the rule, and we will respect. But our bank in Russia is delivering good results, and I think that at the end we need to have a satisfactory solution in this situation. Also because energy prices and gas prices are something that in Europe we have to consider with a lot of attention.
Okay, thank you so much for the time spent with Bloomberg. The Intesa Sanpaolo chief executive, as always, generous with his time with us, Carlo Messina, joining us for an exclusive conversation.
Okay, coming up, with about a quarter of European companies reporting so far, we take stock of earnings season. The beats and the misses, that is next. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has quite cautious stance over the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's individual circumstance and decisions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open, everyone. 44 minutes into the European trading day, and we're looking at sovereign spreads here in Europe widen. Just a reminder, Treasury yields and actually the dollar are for the moment stable, but we are seeing the differential between, for example, a German 2-year and the Italian 2-year. This exacerbated by a lot of talk on the markets. I'm looking at some chats saying that the hawks are now in charge of the ECB. I have to say, this is wait and see. It was also interesting to hear what the European Central Bank Governing Council member, Mr. Knot, was saying. The market is definitely betting on 25 basis point hikes, Tom, in September, but Knot says at least wait for the fourth quarter.
Okay.
So even the most hawkish is not as hawkish as the market.
Yeah, the fourth quarter, and our previous guest suggesting that the ECB, the markets are getting ahead of their skis in terms of how quickly the ECB will respond, but the confusion, of course, created by the statement, the mismatch between the statement, and then, of course, what we heard from Christine Lagarde. Okay, from the macro then to the micro and the corporate story, the earnings story. We are around a quarter of the way through it here in Europe. So let's dig into it then with Tim Craighead, Senior European Equity Strategist at Bloomberg Intelligence. What is the overall take from the earnings season here in Europe, Tim?
Yeah, I would characterize it as positive with a couple of little caveats to watch. On the numbers, so far we're a little over a quarter done, thankfully. We're running with about 60% of companies beating earnings, about 80% to beating on sales. Can't complain about that. A run rate of 29% on earnings growth, which is a little better than the 27% coming into the quarter. So overall, that's pretty good. Tech and financials are doing better. Energy is just blowing the doors off, as you would expect with crude and gas prices where they are.
So, Tim, how's the market pricing it all in? Because it seems that if you beat expectations, your share price flies off the handle. But if you actually disappoint, then you're dead meat.
Yeah, absolutely. Although I would say that over the course of the past couple of weeks, with attention shifting to central banks, whether that's the ECB or the BOE or the Fed, that earnings beats are having a harder time actually generating share performance. On average, actually, the beats are about flat to down a smidge, and that's a market-adjusted number. If you miss, though, you lose. Down a few percent on average, and clearly there's some significant losses on more notable misses.
So you get punished if you miss. You talked about the 80% sales beat. To what extent, though, are those sales wrapping decent margins, or are they having to pay with that?
Yeah.
Pay for that with squeezed margins? What is happening there?
Yeah, this is a critical issue. We viewed it as a key risk factor coming into this year. We're seeing a couple little signs of worry, even though overall margins continue to be exceedingly elevated at record levels. Industrials and materials in particular, I think, are of note. That's where we've had 12 of 18 companies in those two sectors actually miss margin expectation. Now, just miss a little bit, but that's still of note, and pricing there isn't enough to offset cost. SKF was an example specifically up in Sweden as one of the industrials.
Tim, rising inventories, what does that mean for the future?
Yeah, this is a new one to a degree. Now, I think we've talked in the past in various ways about can companies still do just in time if you've got supply chain concerns in the world of pandemics and whatnot. Inventories so far this quarter are up 18% relative to where they were in 2019, pre-pandemic. So that's a big number. Sales are also up. So if you look at it on a sales, inventory to sales basis, 15% versus 12% in 2019. And you might say, oh, it's only a few percentage points, but you know, that's a 25% increase in inventory to sales. That can impact profitability, cash flow. It's something to watch.
Yeah, so for margins, we now look at inventories. Tim, thank you so much. Tim Craighead there from Bloomberg Intelligence.
Yeah, just a great breakdown there of the earnings so far. Coming up, efforts to find a diplomatic solution to tensions over Ukraine continue. President of France, Emmanuel Macron, heads to Kiev and Moscow, and Germany's Olaf Scholz lands in Washington for talks. More next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. 51 minutes into your European trading day, and the sentiment has turned a little bit more positive across the benchmark. Gains of 0.2%. The futures, though, stateside, the S&P E-minis pointing lower by 0.2. The Nasdaq pointing lower also by 0.2. Across your sectors, retail up about 0.9%, but you've got real estate, energy and chemicals in the red. It's really about the treasury markets, though. That is where the action is. The sell-off continues across the sovereign space. You've got a 15 basis point move higher in the Greek 10-year yield. It is currently at around 2.4%. That's the highest since April of 2020. But you've also had yields moving up across Italy, Spain and Germany as well as we react and adjust to what we've been hearing from the central banks, specifically the lack of clarity from the ECB. Okay, let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. Canada's capital has declared a state of emergency as police struggle to contain ongoing protests against vaccine mandates. Ottawa's Mayor Jim Watson says the demonstrations pose a threat to the safety of residents. The protests started in reaction to Canadian and US laws requiring truckers crossing the border to be fully vaccinated. Hundreds of trucks continue to occupy Ottawa's downtown area. Boris Johnson has moved quickly to replace key officials after last week's resignations with a new chief of staff and director of communications. The Sunday Times reports Johnson is preparing for a no-confidence vote as soon as this week, with his advisors estimating between 35 and 45 lawmakers have submitted their requests. 54 are needed to trigger a vote. Australia is to allow double-vaccinated travellers to enter the country from February the 21st. That signals the end of nearly 2 years of strict border controls to stem the spread of COVID-19. Prime Minister Scott Morrison says individual states will still be able to implement their own quarantine rules. Western Australia remains closed to the rest of the nation. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom Francine.
Laura Wright here in London with us. Now, the French President Emmanuel Macron has said to hold talks with Vladimir Putin in Moscow today to find a diplomatic solution to the Ukraine crisis. The U.S. says Russia has amassed over 100,000 troops along its border with Ukraine and is planning an invasion, something the Kremlin has repeatedly denied. Well, for more on all of this, we're joined by Bloomberg's Maria Tadeo. So, Maria, first of all, Emmanuel Macron on his way to Moscow to meet with Vladimir Putin. I mean, it seems unclear why it's be up to the French and whether he would manage to de-escalate the tensions.
Well, Francine, and that's a very good remark, because if there's anything we've learned in this Ukrainian crisis is that the only Western country that Russia cares about and wants to have bilateral talks is the United States. They have the weapons, they have the army, and they have the money. Nonetheless, Emmanuel Macron is hoping perhaps that is the French diplomatic touch that is going to de-escalate tensions. Yesterday, he gave an interview previewing this trip, saying that Russia is a great nation, that the Russians are a great people, but nonetheless, the concerns of all Europeans should be taken into account when it comes to the situation in Ukraine. He also says, by the way I look at this is not about Ukraine. This is Russia trying to shape and redefine the security borders of Europe. Now, in terms of this meeting today, Francine, what we know is that in this room, it will be Emmanuel Macron, Vladimir Putin, and their translators, no one else. Now, this makes some officials nervous in Brussels who believe perhaps at times Emmanuel Macron likes to go solo. They worry about perhaps remarks that are off script that kind of could deter that message that NATO is fully united behind this. But again, going back to your point, it is very unclear what the French can do at this point, because the one country that Russia cares about that really sets the limits in this conversation is the United States. And the question that the Russians are thinking constantly is, will the United States risk a war over Ukraine? That is where they play their game.
And over in the US, President Biden going to be speaking with meeting with his counterpart, German counterpart, Chancellor Olaf Scholz, who's been under pressure, being described as the invisible chancellor. Maria, what's going on?
Well, under pressure, and you can see that, by the way, already reflected in his opinion polls yesterday. Bild on Sunday putting another poll showing that his approval rating is slipping further. Now, you're very right to point out that for many, both in D.C. but also here in Europe, Germany has been completely missing in action over the past 2 weeks. Now, yesterday, Olaf Scholz was also, again, in damage control, saying that a lot of this are misperceptions and some ideas that are not fully factual around German foreign policy. He did say, I'm going to America to meet with my American friends, and the reality is that we're all united behind NATO. He also said, and this really caught my eye, we are working full-time to avoid a war, but we do know that behind the scenes there's always the perennial question about what to do with Nord Stream 2, and of course the energy policy. Remember, we've been reporting at Bloomberg for weeks that the United States is working on a plan should Vladimir Putin cut gas, and what is the plan B for countries like Germany?
Okay, Bloomberg's Maria Tadeo on the ground following the latest when it comes to that meeting we're expecting later today between the German Chancellor and President Biden. The asset move at the moment right now is the Greek 10-year. You've seen a 15 basis point move higher in that yield, currently 242. Stay with us. European Market Open Surveillance Early Edition is next. This is Bloomberg.
going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
We're in a very different position than we were in March, April, May, June of 2020.
Markets have to be prepared for a rate hike at every meeting.
There's a real danger for a Russian invasion.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Klaas Knot says the ECB could raise rates as soon as October. Yields surge as bumper jobs numbers fuel hike expectations. Bolstering the border while the U.S. and France discuss how to strengthen Europe's eastern flank. Macron heads to Moscow to meet with Putin. And the EU pushes to lead on tech standards. This hour, we speak exclusively to the EU Commissioner Thierry Breton. Send in your questions on IB Plus TV Go. Also, red hot oil, Europe's dependency on Russian gas, and energy poverty in the UK. Later this hour, we have much more in our half-an-hour special, the price of power. But first thing is first, so let's check on the markets because we're seeing a repricing and a widening of spreads between German yields and much of the periphery. Now, this is on the back of European stocks actually gaining some 0.4%. Remember, if you look at China, they had a week-long holiday. They're back and they're playing catch-up. So a lot of the technology stocks are actually supported in China. That's filtering through to Europe. We also had some expectations or earnings that were better than expected, but it's all playing out in this space. The Italian 10-year yield, you can see at 1.816, and there's the biggest differential in at least 12 months with, for example, the German bond. The widening gap just keeps on widening. It certainly did in the last hour or so. The focus is what we heard on the ECB, and it came in the Q&A with Christine Lagarde. Definitely a lot of market participants thinking now the hawks have been taking place at the European Central Bank. This would have an impact, of course, on when they start hiking. But then we heard from Klaas Knot saying, look, this could come as early as October. The market is actually pricing in a 25 basis points hike in September. And this brings me nicely to the map where you see support for the DAX getting 0.4%, the FTSE on the CAC 40. But Italy, probably the one that's most sensitive to some of these yields, actually down some 0.3%. So the ECB Governing Council member Klaas Knot says he expects an interest rate increase as early as the fourth quarter. That comes after the Euro area central bank made a hawkish pivot last week with President Christine Lagarde now no longer excluding a hike this year. Well, we're joined by Jane Foley, head of FX strategy in Rabobank, and Bloomberg's Christina Aquino. First of all, thank you both for joining us. But Jane, what did you make of that hawkish pivot? Because it's unclear whether it was coordinated, so with the rubber stamp approval of the Governing Council, or whether it was a slip up in the Q&A.
Well, we're going to find out, and we'll find out really over the next few days. And I think Lagarde may be scheduled to speak this afternoon too. And I think this is the period when the dust is settling, when she is able to, her and perhaps Lane and some other members of the Governing Council will be able to give us more direction. What did she mean? Yes, we've had that hawkish pivot. I think we all understand that. But did she really mean to imply, as markets have interpreted, that rates could be going up by 40 or 50 basis points by the end of the year? Perhaps that's too much. So I think this is going to be a really important few days, a couple of weeks, whilst she really does give us a little bit more clarity into what she actually means.
Yeah, and Christine, this, of course, is something that we've been talking about quite a lot, and it's my morning must-read comes from Eric Nielsen that lays out the concern, is that, we heard from Isabel Schnabel, we heard actually from Philip Lane as well, and they didn't see much movement in terms of the hawks taking place, and suddenly we have a repricing of markets.
Absolutely, Francine, and so it really will be a communication challenge now for the ECB Governing Council. Now that they've seen that initial reaction to the possibility of an ECB rate hike this year, they can kind of finesse that message, as we hear from Lagarde and other Governing Council speakers this week. I think it really will be now all about the nuance in terms of the timing and pace. Of course, this is something that's very, very much on the radar for markets, and something that they will definitely be watching these speeches for, and seeing any detail from there as to any indication of how fast the ECB could go, and when they're really going to fire that first shot in terms of rate hikes.
Jane, let me bring you to my morning must-read, which is Eric Nielsen actually laying out some of the concerns he has when it comes to ECB policy and that pivot, a lot more hawkish. Overall, do you worry about the Bank of England and the Fed being behind the curve more than you do about the ECB actually, delivering a confusing message like Eric Nielsen supposes?
I think what we've got to understand here are the differences between, these three economies. And in the Eurozone, I think it's fair to say, and I think Lagarde, has always made this clear, that in the Eurozone, there still isn't that wage inflation threat. So she isn't behind the curve, so to speak, in the way that maybe you could accuse that the Fed of being. They don't have those second-order risks through. But, she is mindful, as most economists are, that the longer inflation remains elevated, the longer that, or the bigger the risk, that it feeds into second-order effects, feeds into inflation expectations. That can have an impact on, say, wage negotiations, etc. So she wants to, kill it now. Kill those the risk of those second-order effects. But if we go into the US, look at that wage inflation number that we saw on the payrolls last week. That's a different story. The Fed, I think, you can accuse of potentially being behind the curve, and I think the Guard really needs to explain those differences. And I think that's perhaps what we're going to hear more of in the coming weeks.
Yeah, and we can see our Valerie, of course, our market watcher, really saying, look at the Greek 10-year now 21 basis points higher. Christine, I know these are big moves, but put into context, I mean, they could come down if the ECB were to say something like they're here to close spread. So are we going to see, dip buying in bonds?
Yeah, that's the big question, Francine, for sure, because it's really not just the ECB, that could keep those bonds in control and compress. There's also a bevy of investors that have been long suffering through negative European yields, or really, really low European yields, are suddenly coming to the realization that that era is really about to come to an end, and perhaps increase the attraction of European bonds. We know, for instance, that Japanese buyers, especially those pension funds, life insurance funds, are really big fans of the European bond market, but they just haven't been able to really buy into this market for the longest time because of the really low rates here. But now that we're seeing signs of this era coming to an end, potentially you could see that inflow of foreign demand now that the yields are yielding a little bit more above zero in the case of Germany, and quite a bit more in the case of the periphery.
Jane, if you put this into context with us, I know it feels monumental and it will have all sorts of repercussions for the rest of the yield curve, certainly in Europe. But then you look at the Fed and how they've messaged forward. I mean, we could see this global bond route deepening also impacting a lot of the FX.
Oh, completely. And, we've seen that to a large degree already. When we look at, euro dollar, I have been anticipating that it might be the second half of the year when we begin to see this turn in the euro, where we begin to see the market really focused on the possibility of tightening that for the ECB. But, we've got this much sooner than I had anticipated. We've got this turn. And it's quite interesting last week that we had, the RBA also have this hawkish tilt as well, indicating that there could be an interest rate hike after all this year, despite the guidance that we've been having. We might have the sixth bank later in the week. Perhaps that's going to be the next central bank to announce this hawkish tilt. So we are having this movement coming through, quite suddenly. And of course, it comes on the heels of the Fed, through November, December, early January. It was amazing to see that fast pace of acceleration of the hawkish rhetoric, really quite startling. So we are seeing this move, and it is feeding through into foreign exchange already. And of course, it really is. Will the euro continue to go higher now, or will Lagarde, try and make a little bit more sense of this and say, yes, we've made a hawkish tilt, but that's all it is for now. So it's going to be interesting to see what happens there.
Yeah, and we see those yield spreads widening. Thank you so much, Christina Aquino, our markets editor, and Jane Foley, head of FX strategy at Rabobank. Both stay with us. Now, this is a huge repricing, actually quite monumental, and it could continue further until we hear from more ECB Governing Council members. Just a reminder, the market expecting a 25 basis point hike from the ECB as soon as September. But actually, we had comments from Klaas Knot over the weekend, the hawk of the hawks within the Governing Council, and he was saying this would probably happen in the fourth quarter, but then he's expecting another one early 2023. Now, coming up, U.S. job numbers surging despite record COVID infections, adding more pressure on the Fed. More on that next. This is Bloomberg.
Has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
A very good report, a very solid report. And I think underlying what it's telling us is that we're in a very different position than we were in March, April, May, June of 2020. We're seeing people in economies, in workplaces, and workers and employers really learning to live with the pandemic and adjust. So we are in a different place there.
Well, that was U.S. Secretary of Labor Marty Walsh speaking to Bloomberg after the release of the latest U.S. jobs report. We're back with Jane Foley, head of FX strategy at Rabobank. Jane, we spent a good amount of time talking about the ECB, but it does seem that the world's most important policymakers as a whole are taking turns to emphasize exactly how the market expectations or the market's environment is in the process of this momentous shift because of a hawkish tilt. So who's getting it right, and what do you think is being mispriced at the moment?
Well, I think I mean, we can talk about mispricing or we can talk about just adjustment, because I think what we've seen is just a very rapid adjustment coming through from the rhetoric from central banks in terms of, what's happening in the economy. And I think if we go back perhaps even 6 months, we were still using the term transitory. We were still anticipating that inflation was going to go away because we were saying, well, this is all to do with supply side. But I think what was ignored was the real big shift in demand. And perhaps that was related to this huge amount of fiscal spending that we've had from various governments, the US certainly included in that. And I think we've had this permanence perhaps in inflation at least through for a far longer period than most of us had anticipated a year ago. So that's what we're adjusting to. The central banks are adjusting to that. You asked the question previously, are the central banks behind the curve? Perhaps the Fed is, but certainly it's going to come through. And I think the next question will be, after all of these hikings take place, particularly in the US, can we avoid recession? Will there be a hard landing? Right. Can they get it right? Can they get the amount of tightening just right to avoid that hard landing?
So, Jane, let's go back, because we are seeing a meltdown, certainly in some of the Italian bonds. Let's go back to those spreads and bring them up on screen. But I guess the key question then for investors overall, no matter where you are in the world, is how much of the tidal wave of tightening should be priced into assets immediately versus gradually. So do you think the repricing is too aggressive right now?
Again, that question is going to become a lot clearer perhaps in 3 months' time as we begin to look back. I think Lagarde's real aim in the next couple of weeks will be to try and send out a message that, yes, they've tilted, but they're not going to be hiking particularly aggressively. They don't perhaps need to in the EU yet, because we don't have much of that second-order effects. They just want to stop those second-order effects appearing. Different story in the US. We already have the second-order effects. That's why they're going up very aggressively. But if you look at some of those yield curves, for instance, if you look at the yield curve in the US or the yield curve in the gilt market in the UK, you're seeing quite a lot of flattening. And that is a message I don't think we should ignore, that we can ignore. And that is something that suggests, well, look, there is a danger here of these central banks tightening so much to get this message through about inflation that they could overdo it. And we could actually, by the end of the year, really be ratcheting up the risk of recession. And I think that's, the next part of this story.
Yeah, and I guess into this vulnerable bond market comes also this US CPI print that's forecast to rise again. Jane, what does this all mean for dollar? And maybe the differential there to play is renminbi dollar.
Well, if we look at renminbi, then we know that we're looking at a Chinese economy that's slowing. We're talking about increased accommodation. And naturally, if you've got a central bank wanting to do more accommodation, you generally see the currency slip. And I think that's what's going to happen. I think the more interesting story really is the dollar. And also, I think we've got to think about the dollar in the context of an economy, of a central bank that's tightening. But also, the dollar is a safe haven. And this, I think, complicates the story here, because we have, of course, these potential safe haven flows coming through from what's going on in Ukraine, Russia, what could happen at that border, but also, something that perhaps it's been a little bit more ignored in Europe, and that is what's going on in terms of China. We do have Blinken going over to Australia, Hawaii, etc. This week. There's going to be a meeting between some of the Quad countries, India, Japan, etc., and that's related to China. So there is the potential here that we could see the dollar as a safe haven coming closer to the fore. And I think that's something which could help support the dollar through this year as well.
Thank you so much, Jane, as always, for joining us. Jane Foley, their head of FX strategy at Rabobank. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Canada's capital has declared a state of emergency as police struggle to contain ongoing protests against vaccine mandates. Ottawa's Mayor, Jim Watson, says the demonstrations pose a threat to the safety of residents. The protest started in reaction to Canadian and U.S. laws requiring truckers crossing the border to be fully vaccinated. Hundreds of truckers continue to occupy Ottawa's downtown area. Now, the White House says President Joe Biden and his French counterpart Emmanuel Macron have discussed their response to Russia's military buildup on the Ukrainian border. The two talked about moves to strengthen NATO's eastern flank and efforts to deter Russia from invading. That comes ahead of Macron's trip to Moscow and Kiev that's due this week. Russia has repeatedly denied it does plan to attack attack Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, the EU unveils a new strategy that seeks to counter China's influence over global tech standards. We speak exclusively to the EU's Internal Markets Commissioner. He's Thierry Breton. He's up next, and this is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, the European Union is seeking to boost its role in setting a standard for key digital and green technology. That's amid concerns that China and some corporations are wielding excessive influence. Well, the Commission's plan is to leverage cooperation with the U.S. and other like-minded nations. Well, let's head over to Bloomberg's Maria Tadeo, who's in Brussels with a guest.
Yes, and Francine, I'm joined by the man himself, Commissioner Thierry Breton. Thank you so much for joining us. It's always good to see you. And, you know, this CHIPS Act that you're presenting, you say this is going to be huge. What does huge mean in actual terms? How much money?
That's a lot of money, yes. That's a lot of money that we need to put on the table to support our company. Because in Europe, we are the center of the world in terms of R&D for semiconductors. But it's true also that we don't manufacture enough. Most of our semiconductors, and you know, everybody knows what you do with semiconductors. You use it in your smartphone, in your car, in your fridge, but also for health, but also for computing, everywhere. But this is now mostly manufactured in Asia. And when I say Asia, it's around Taiwan.
China.
No, it's more Taiwan, Korea, South Korea, Japan, a little bit China too, but Taiwan, yes, more than 50% is coming from Taiwan, and we know that it could be a little bit tricky over there. So we have decided now to increase drastically, to multiply by four, the production of semiconductor in Europe within the next 10 years, but also to make sure that we'll be able to bring all the money for R&D. We'll put on the table 12 billion euros just for R&D. And in addition, 30 billion just to support mega fabs, and also a significant amount to support startups. Altogether, you know, I said that it will be probably around over $50 billion. Yes, this will be the case.
So that will be the case. So help me understand, you know, we say 50. I mean, this number looks huge from the outside. I mean, you could argue it's comparable to what the U.S. is doing. Is this going to be public money? Is this going to be private? Are you tapping into European enterprise? How do you structure this?
When I say around $50 billion, it's just, again, supporting. So it's grants and it's public. And in addition, of course, we will have a lot of private money. So this is pretty huge what we are doing here in Europe.
And you say it's pretty huge, but I wonder, is this because perhaps you're concerned about China? This is how it's, you know, often gets presented. I mean, this is not a secret that China comes into Europe, they buy everything up, they take it away, and then we have nothing left. Is that the reason why you're doing it?
That's a good point, because we need, in addition to this, we need also to secure all the supply chain. Not only we will make the most advanced semiconductors in Europe, and I said for the specialist, below 2 nanometers, which is extremely, extremely complex semiconductors we will design and manufacture here in Europe, but also we need to make sure that all the line will be secured, whatever could happen. And that's why, again, of course, we will work with our like-minded partners. But, you know, if you have a crisis, and we learn this the hard way, especially for the vaccines, even your best partners, like US.
Becomes a rival at times.
I mean, not rival, but, you know, they have to serve their interest before the others. This is why, you know, in the US, you have the DPA, you have a special, let's say, act to protect in case of crisis. We do the same thing in Europe, of course, to make sure that if there is a crisis, we'll be able to secure our supply chains.
And do you worry perhaps that countries, rivals, perhaps strategic like China, but also friends like the United States may say, Europe is becoming a little bit protective over there?
Not at all, because we are doing exactly what the US are doing, and we are discussing a lot with our US friends. But of course, we are not naive, and we are a power. So we need to behave, just not being naive, and being a power. We know what we can bring for us and for others. By the way, we will export a lot of semiconductors also for other non-EU markets and for our friends. But we need to make sure that we can secure the supply if there is a crisis. But we are not at all protectionist. You know, we will not do more than what is the US doing in case of a crisis with the DPA.
Well, Commissioner Breton, thank you so much. It's always nice to see you. Thanks for being on Bloomberg TV, as always. Francine?
Thank you so much, Marianne. Thank you so much to the Commissioner. Coming up, we have the price of power, half an hour to talk about the red-hot rally. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Well, good morning, everyone, and welcome to the Bloomberg Price of Power special, looking at the global energy crisis. I'm Francine Lacqua here in London. Now, taking a pause, oil fluctuates after 7 weekly gains. Saudi Arabia boosts prices, signaling confidence in demand. Europe's Russian gas problem. Well, no signs of de-escalation between Moscow and the West over Ukraine, the continent's energy dependency in the spotlight. And UK energy watchdog Ofgem amends its price cap regime, while British households could face a worst squeeze ever. This hour, we speak with the chief executive of energy provider Ecotricity. Now, Brent crude fluctuating in Asia, trading today following a run of 7 weekly gains that pushed oil to the highest level since 2014. So here to take us through what's up with oil is Bloomberg's Danny Berger. Danny, first of all, how tight is the oil market right now?
Francine, it's so tight that currently we are in super backwardation. Not only is it industry speak, but just frankly, it's a very cool phrase. Essentially, this means that the curve is very steeply downward slope, so traders are happy to pay up for contracts now versus into the future. The fundamentals do support this very, very tight picture. You have extreme cold in the Permian Basin, which means that that's curtailing U.S. output. There are questions as to whether OPEC Plus can hit its output targets, and of course, geopolitical concerns that continue to add risk to the upside.
So I guess, you know, the million-dollar question is how high do traders think it can go?
There are very high bets at the moment. We've heard a lot from Wall Street saying a triple-digit oil. $100 really isn't that much of a stretch at the moment, considering we have Brent in the low 90s. Francisco Blanch over at Bank of America continuing to say 120 we could see on oil. We heard JP Morgan last week join in on that call if we have increased geopolitical tensions. And at the moment, option traders have gone wild for really steeply priced oil options. The amount of $100 calls right now is equivalent to 112 million barrels of oil, and options for 150 and 200 striked calls have quadrupled since the start of the fourth quarter. So these are some really big bets in the options market.
Huge bets. Danny, thank you so much for Danny Berger there with a look at the charts, looking at some of the things that we should worry about. Now, we're joined by Jeff Curry, Global Head of Commodities at Goldman Sachs, and Fiona Boll, Head of Commodities and Real Assets at S&P Dow Jones Indices. Thank you both for joining us. Jeff, I know you have a $100 call. When can we reach that point?
Right now, the upside risk in this market is exceptionally high. One of the reasons why, is alluded to, the markets are incredibly tight from a physical perspective. Whether you see it on the refining margins or in crude oil itself, the entire complex is extraordinarily tight, reflected in that super backwardation. Obviously, what it means is that this market is incredibly vulnerable to any type of supply or demand disruption, very much like what we saw in European gas and power, let's say late last year. So oil has now teed itself up, to look very similar to what European gas and power looks like. That was what we highlighted this risk back in October of last year. We're at that point right now. And so the question is, can you come up with any supply or reduction in demand as you move into the spring to be able to ease the situation?
All right, let's get to Fiona, and then I want a bit of a timeline from you, Jeff, about when we could see this happening. Fiona, what are you expecting in terms of prices by year end and from now and then?
I think, as Jeff said, we're really in a very tight situation. We talk about being at tank bottoms, so we just don't have that leverage if something goes wrong. So if we see, continuing situation, I would expect, prices to remain, around where they are, but there is definitely the risk to the upside, and it's not insignificant.
So, Jeff, talk me about, I don't know whether we can talk about sequencing in the price of oil, but once it touches 100, are you expecting it in the next couple of months? And then what happens? Is it a trend of higher, or could it readjust?
Well, it's difficult to say, in terms of what kind of, demand is far stronger than I think what anybody thought, because the Omicron impact is not as significant as even we embedded in our models. And then we look at the supply situation, the continued underinvestment in supply leaves this market incredibly vulnerable. Now, the question is, what is the upside limit here? One thing I like to keep in mind is if we think about the amount of liquidity in the system today, and we look at oil versus liquidity, the run-up we see in Canada, you don't even see it on a picture. Because the liquidity so overwhelms the movement in oil and commodity prices. And a lot of people go, okay, look at oil as a share of GDP. Let's think about it in terms of liquidity, because that really determines on the ability of the system to be able to deal with these price increases, particularly when some of that liquidity is going to the lower income groups.
So, Fiona, this is the chart that we were talking about, and it shows exactly what Jeff is mentioning, right, which is Brent showing this unusually strong backwardation. And actually, if you bring it back, there are only 11 trading days since 2008 with an equal or stronger, second to third time spread. So how tight is this? Is there, have we seen any signs of demand destruction yet as prices soar, actually?
Well, if we look at the European power market, we've certainly started to see, signs of demand destruction. The same here in the UK, with some falling off of sort of manufacturing demand for things like natural gas. And I would expect that we may be getting close to that point in the oil market where we do see some demand destruction. But for now, again, as Jeff said, demand's incredibly tight. I've been amazed, particularly in the US, with the distillate demand, really illustrating just how strong the manufacturing and the transport sectors are.
Jeff, the call option activity is really exploding. What does it tell us?
The expectations of the market is substantially higher from here. Because I think what this pricing is the asymmetry in the risk profile. Because when your inventories are incredibly low, at tank bottoms, you expose the market to these upside price spikes, and that's what the option market is trying to price right now. But I actually want to emphasize here, the participation from the investor community is extraordinarily low. The liquidity is a fraction of what it was going back, let's say a year and a half ago. The investors have abandoned the space on commodities, equities, anything commodity related or old economy, which just creates more upside risk here at this point.
When are you, Jeff, expecting some kind of significant demand destruction?
It's clearly at higher levels from here. We think you get into that 105 range. Places like India, Indonesia, Brazil start to run into problems. We'll see what happens to the dollar in that environment, because if you get a weakening dollar, it buffers them and then the price can go much higher. But that's using historical relationships. And those historical relationships may not be appropriate here with the type of liquidity that's in the system.
Fiona, are we looking at a 2008 kind of shock? I know it's difficult to put, the price of oil, or certainly the oil markets, in parallel with the recession that we saw. But what parallels would you draw, if any?
I like to say,
I think it's
2000. Oh, sorry.
Let's do Fiona first, and then Jeff, you can come in.
Okay.
No worries. I think it's difficult to draw a parallel to what we're seeing now. We really are seeing very strong demand, but at the same time, we're going through this so-called energy transition, and that was not the case in 2008. So, you know, we're talking about massive underinvestment in these so-called, bad sources of energy, of which, you know, oil is at the top of the list. And so the situation is quite different than what we saw in 2008.
Jeff?
Now, 2008 was a financial crisis. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alloy, you name it, we're out of it. And it's, you know, the backwardation in this market is an indication of just how different this market structure is from 2008. 2008, the curve was going up by the back end, dragging it up. It was in contango at some points in time, which tells you it was paper financial buying on the back end as opposed to outright shortages. This curve is super backwardated, and many of these commodities are super backwardated, which is, you know, textbook shortages. In fact, you know, when Keynes created, you know, the idea of backwardation in the 1930s, you know, this was what he had in mind, and we have not seen such types of backwardation. I've been doing this 30 years, and I've never seen markets like this. This is textbook shortages.
Yeah, and actually, let's bring back, I like your hand movements, Jeff, but I'm going to help you out and actually put that chart up looking at the backwardation that we've seen. I think we're looking at Brent, and again, it's only 11 trading days since 2008 with equal or stronger second, third time spreads. There you go. You see it there. We'll have plenty more, of course, with Fiona and Jeff. Fiona Boll from S&P Dow Jones Indices and Jeff Curry from Goldman Sachs. Now, coming up, the West is in dialogue with Moscow, while at the same time depending on Russian energy. We'll discuss that story next. This is Bloomberg. We're also looking at the global bond rout, definitely deepening as we have those job surges in the U.S. They're boosting rate hike bets, not only with the Fed, but also the ECB now coming into play. If you look at the spreads in Europe, they're widening. There's definitely a melt up with the Italian 10-year yield now at 1.841. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
economics, finance, politics. This is Bloomberg Price of Power, looking at the global energy crisis. I'm Francine Lacqua here in London. Now we're back with Jeff Curry from Goldman Sachs and Fiona Boll from S&P Dow Jones Indices, both still with us. Jeff, when you look at the concerns, of course, over Russia and Ukraine, with Russia saying, look, they're not ready to invade, but also the amassment of troops at the border, what does that do to gas prices going forward? And is it, is something ugly happening on the geopolitics already priced in, or could we see real disruption?
Well, I think the probability of a disruption is still very, very, very low. We don't have data to go back this far, but I've been told the only time we've ever seen Russia stop supplies to Western Europe was the day Hitler invaded Russia, and was it 30, whatever. We don't know if that's true, but I tend to think, again, the game theory of that is probably true. It's mutually assured destruction between Western Europe and Russia. There's no, it's not in the interest of Europe to cut, consumption of it, not interest of Russia to cut the supplies. The market prices in the potential for, let's say an accident, the risk of an accident in Ukraine or something like that could be very devastating. But in terms of thinking about the implications of an outright stoppage, I go back to the idea, your game theory is mutually assured destruction.
Fiona, what exactly is priced in on the markets right now?
I think the market is pricing some risk, but it's certainly not pricing the worst case scenario. There is little incentive for it to get to that, and the market seems to be reflecting that sentiment.
Fiona, talk to me a little bit about some of the renewables. So first of all, on the subject of energy dependency, right? This month we spoke to the Ørsted chief executive, Mads Nipper, and he told us that solar and wind could offer a solution to the price swings we're currently seeing. So first of all, let's listen to the chief executive.
The fact that prices have spiked means that we need to accelerate the build-out of renewable energy and therefore be much less dependent on gas imports from different parts of the world. Both wind and solar build-out combined, hopefully also with more storage, is the solution to these price swings, not the reason for it.
Fiona, what kind of price or what kind of temperament do we need or temperance from renewables do we need to make sure that the energy prices stay on track?
Look, I don't think it's an issue of wanting the energy transition. The trick's in the title. It's a transition. It's going to take time. So I'm not sure even a significant spike in the price of traditional energy sources is going to be able to accelerate the build out of those alternative sources quickly enough. I think we're in for a pretty wild ride over the next few years as we try and move as quickly as we can to adopting more of those renewable sources into our global energy plans.
Jeff, I want to bring everyone's attention to a wonderful column piece that our Javier Blas from Bloomberg Opinion has put in place. And basically he says, look, the world needs to give up its addiction to fossil fuels. That's what a lot of governments want to do. But really, as the UK is discovering, it's not going to be easy and it's not going to be cheap. Do markets forget that, Jeff?
Yes, completely. I've forgotten it, and I think that governments need to do this in a very global, uniform fashion because one thing about climate change, local solutions don't solve the global problem. We need a global carbon tax such that everybody's facing a similar type of tax. And as you want to reduce the overall consumption, you turn up that tax or that carbon price to achieve that. The problem with ESG, it's a blunt tool. It's cutting supply overall across all hydrocarbons at a rate that is too quick, and it creates the equivalent of a carbon tax where you don't collect the tax revenue and the price is substantially higher than what you would get under a carbon price or a carbon tax. So right now, we're not in an environment in which we're starting to create a organized way to reduce that dependency on hydrocarbons.
So, Jeff, we have some of the calls on where you're expecting them to go. When do you expect the price of oil, but also gas, to ease off a little bit? I know over the weekend we also had this big refinery outage in Texas, and the U.S. products market is already tight.
Well, in terms of thinking about the product markets, it's reflective of that strong demand, better than expected demand due to the fact that Omicron wasn't as severe as it ought. You also have outages of refineries. We have, high carbon prices in Europe, making it more costly for refineries to operate. So you're exacerbating an already extremely tight product market, again, emphasizing just creating more upside risk in product prices as well as oil prices.
But Fiona, I mean, the role of OPEC, they said they will try and add more supplies, but actually so far they've failed.
They sure have. My colleagues at S&P Global Platts think they're only going to do around an additional 200,000 barrels a month, so that's half of what they've said they've done. It's really only Saudi, the UAE, the usual suspects that have any spare capacity, and we shouldn't forget that these are country-specific quotas that they're working under now. So even if Saudi was going to increase production, it would be going against the so-called rules of OPEC plus.
All right, and let's also remind, of course, everyone that we talk about it from a trading point of view, but if you look at the U.S. pump prices, they've been the highest since 2014, and we have a great chart illustrating that as well. Thank you both for joining us for a spirited conversation. Fiona Boll, Head of Commodities and Real Assets at S&P Dow Jones Indices, and Jeff Curry, Global Head of Commodities at Goldman Sachs. Thank you as ever. Now, coming up, we stick with energy as we focus on a pioneering UK company that seeks to alleviate the country's growing gas prices from sustainable and green sources. That story up next. This is Bloomberg.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Price of Power. Francine Lacroix here in London. Now, Dale Vince left school at 15 to join the New Age traveller community. By 1995, he'd founded the British renewable energy company Ecotricity, which now supplies around 200,000 customers. In recent months, he's been calling for the government to impose a windfall tax on North Sea oil producers and for a public inquiry into the UK's energy market. Well, we're now delighted to be joined by Dale Vince with the very latest. So, Dale, thank you so much for joining us. If you look at what some of the governments have been put in place, some of the policies, certainly that the Chancellor wants and the Prime Minister want, what do you think about the price cap and what the Chancellor wants in terms of bills?
I think the price cap has fundamentally caused the pain that we've felt in Britain, which is beyond the pain felt anywhere else in the world, I think, from the spiking global prices. Because by holding retail prices down, allowing wholesale prices to rise well above them, the government had forced companies to trade at a loss, and that has bankrupted 30 players in our energy market, nearly half the entire sector. So that's a fundamental problem. I think what the government announced last week, lending customers £200 to help them pay, which by then will be a £1,000 bill rise, is pathetic, actually. If energy prices are too high, government should actually do something about it. And of course, a windfall tax, we're seeing about 20 billion excess profits made in the North Sea. That would make great sense. It'd be very ethical to do that. Sorry, it was a long one.
So I guess, Dale, I mean, first of all, how do you think it will be easy for energy companies to roll out the discounts? And if you're asking for, a tax on something else, maybe it puts more pressure on the economy. So first about the rollouts and the tax incentives, how easy is it to do that?
It looks really complicated to me. It looks like it adds another massive layer of complexity to energy bills. They're already complex. It kicks in October. I don't actually know if the £200 is in one lump or if it's spread over 12 months, but we know that 12 months later, it has to be repaid at the rate of £40 a year or something, and again, probably spread over 12 monthly payments. So it looks very complicated and drawn out. And, the 20 billion windfall tax is not going to be harmful to our economy because, these guys in the North Sea sector weren't expecting to make this money. They don't need this money, and it won't harm investment in the North Sea.
So why do you think the government's not doing that?
I think the government are very close to the oil and gas industry. We subsidize it already. It was proved in court in Britain about 2 weeks ago that we put more money into the North Sea by way of subsidy than we take out by way of tax. So fossil fuels are a loss-leading product for Britain in the North Sea, and it doesn't make any sense. We should be spending that money on renewable energy. As a previous guy said, the oil stood high. That's the way to solve the problem.
Yeah, I mean, we also have this great, and at times, Dale, I guess it's not as easy as people would want to. Or Javier Blas also wrote this beautiful piece saying, look, the world definitely needs to give up its addiction to fossil fuel, but as the UK is discovering, it's not easy and it's not cheap. Give me a sense of, when you look at the discounts that you think are extremely complicated to roll out, are you worried about the timeline that actually they get, you get the relief in October when we could see another increase in prices?
We will see another increase in October. I think that's pretty certain. That's why I referred to the £1,000 total bill rise by October. I think renewable energy, is often described as being not cheap, but it's the cheapest form of new energy that we can build, and we have to build new energy. And if you look at this crisis, this fossil fuel crisis this winter, this cost our country £20 billion at least. The bankruptcies in our energy sector have cost us another £4 billion. All of that money is wasted. We could have spent that money on infrastructure, renewable energy infrastructure, to help us reduce our dependence on global markets.
Yeah. All right, thanks so much. Dale Vince there, of course, for all the green energy promises and plans. Our Javier Blas also argues that the current energy transition is just in its infancy. Dale Vince, he's chief executive of Ecotricity. Now, that's it for today's Bloomberg Price of Power special. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kaylee Lyons in New York. Anna Edwards is here in London. Huge yield moves, certainly when it comes to BTPs and bonds. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modelizaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're in a very different position than we were in March, April, May, June of 2020.
We did what we could on the fiscal side to make sure that we had a swift recovery. It is up to the Federal Reserve to use their toolbox to ensure price stability.
The Fed wants to tighten financial conditions, but it doesn't want to crash confidence and over-tighten.
Markets have to be prepared for a rate hike at every meeting.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Monday, February 7th. Our top stories today. The global bond rout spreads. Strong U.S. jobs data and hawkish ECB comments stoke expectations that central banks around the world will be aggressive when it comes to raising interest rates. President Biden and France's Emmanuel Macron discussed the Russian military buildup near Ukraine a day before Macron heads to Moscow. Meanwhile, Germany's Chancellor Olaf Scholz makes his first visit to the White House since taking office. And shares of Peloton are soaring today. There are reports the fitness company is exploring takeover options. Welcome to Bloomberg Surveillance, everybody. This is the Early Edition. I'm Anna Edwards, live in London with Matt Miller and Kaylee Lines over in New York. And Kaylee, another week of focus, it seems, on the higher rate environment.
Yeah, absolutely true all across the world, Anna. And that definitely was true in Asia overnight when it came to some of the selling pressure we saw in the bond market. As far as how the session went down in the equity market, though, mostly it was lower. The MSCI Asia Pacific Index off a few tenths of 1%, just about a tenth of 1% or so. One exception within that, though, was China, which opened back up after the Lunar New Year holiday. The best post-holiday open, in fact, going back to 2019 with that CSI 300 up about 1.5%, likely playing a little bit of catch-up to the rally we saw in other global benchmarks last week while that market was closed. Hong Kong was lower, though, and that was really a drag led by technology, and that technology drag was led by Alibaba. Those shares in Hong Kong down 4.5%. It filed with the SEC here in the U.S. on Friday to register 1 billion ADRs that hadn't been registered before, and a Citi analyst saying that may indicate that SoftBank may be getting ready to sell part of its Alibaba stake. So that dragged those shares lower today. And speaking of selling things, as I said, you did see that selling pressure in Asia Pacific bonds overnight, including in Australia. The 5-year yield there up 7 basis points to 1.71%. That is the highest going all the way back to March of 2019. So about 3 years, Matt.
All right, so we'll be watching very closely the rates picture. The question is, does that
if anything, say something about what's going to happen in equities. S&P futures right now down. Just about a half hour ago they were up, but not big movements. And we didn't have a big close on Friday either. You had the S&P up about 0.5%. The Dow was down just about 0.1%. So not a lot of action in equities. It's all about rates. You can see the 10-year yield here up 1 to 190.86 right now. Investors are still selling off bonds just a little bit. Not a lot of movement there, but the levels are what you want to watch, and especially the levels in spreads wherever you look. NYMEX crude is coming down 1.25%, but still well over $90 a barrel. So 91.13 is a level there as the geopolitical situation fails to calm down. And then Bitcoin up 2% today, 42,511. So does this say anything about where we go in equities? It has been a risk indicator, but doesn't look like it today, Anna.
Yeah, absolutely. The equity story is linked, of course, to the bond story and those Tina narratives. There is no alternative. One of the key reasons for holding stocks. How does that fare then, Matt, as we go through this higher rates environment? Is that something that's weighing on European stocks in some places, or is this very much around the divergence we're now seeing across Europe and fear around debt levels in some southern parts of Europe? So we are seeing some northern parts of Europe. The equity map is looking fairly green still. The brightest red, though, coming through in southern Europe. It's not 2011, but it does seem as if we are going to be talking about some of those similar themes around spread widening. I'll show you that in a bit more detail. I've got the Italian BTP yield over the German Bund, and this shows some widening. This has been widening this morning, continues to do so, 163, the highest since the early days of the pandemic we're talking about here. London, meanwhile, cushioned by what we're seeing in basic resource stocks. That's the sector moving to the upside in today's session. Reckitt Benckiser Group, another stock in focus in London. That one moves a little bit higher. A Bloomberg scoop there. They could be interested in selling their infant nutrition business. It had been really key to that consumer goods company. And Faurecia, this is a company that bought one of its German rivals, all about auto parts and pivoting, really restructuring and moving towards electric vehicles. How well can they do that? They put out some new targets today that have gone down well with the market. That stock up by 2.7%, Kaylee.
All right, a few stocks to watch in this Monday session, and there's a lot else to watch on this Monday and through the week ahead. Later today, U.S. President Joe Biden will be hosting German Chancellor Olaf Scholz to discuss the situation in Ukraine. Those two will be meeting at the White House this afternoon here in the U.S. Meanwhile, French President Emmanuel Macron plans to visit Russia and Ukraine on Tuesday. Also on Tuesday, SoftBank reports its earnings. Founder Masayoshi Son will face investors with a number of major questions. And then the big data point of the week here in the U.S., CPI on Thursday. Inflation still expected potentially to have a 7 handle. Finally, we'll get more European bank earnings with Credit Suisse, BNP Paribas, and Societe Generale throughout the week, Matt.
All right, hawkish bets on rates are moving higher, and ECB Council member Klaus Knott says he expects a hike as early as October. Now, he's no dove, so that's not a huge surprise. But last week, the ECB made a hawkish pivot with President Christine Lagarde no longer excluding a rate hike this year. Let's get more with Christine Aquino, who helps lead our markets coverage. And the story, certainly in Europe, is all about rates, Christine.
Absolutely, Matt. We're seeing a major repricing in these money markets, particularly for the ECB. I think especially because the ECB prior to last week was seen as the furthest away from this prospect of rate hikes. You might remember that before last week, we saw commentary from ECB Governing Council members, even in January and in the early days of February, saying that, they're really not looking at rate hikes until 2023. That all went out the window last week. We saw an indication from them that they're not going to be ruling out a rate hike this year. Now, the big question is, of course, when they're going to fire that starting gun on rate hikes and how fast they're going to go, both on the tightening cycle and also in terms of their asset purchases.
Yeah, and so good morning to you, Christine. If this is all about nervousness about just how quickly we get then this move from the ECB, interesting to ask what that does to the periphery of Europe, because that's where we seem to be seeing the market reaction quite extreme this morning. The BTPs, the Italian debt products, but also over in Greece. Are you worried more about that on the sovereign side, or is it the spread widening we're also seeing in European corporate debt, in the high yield and also investment grade?
Well, and I think these are things that we should all keep an eye on, both on the credit side of things and the periphery side of things. These, of course, are the more risky parts of the European debt market and potentially more vulnerable to a faster pace of ECB tightening if we do, in fact, get there. And so very much keeping a focus on those Italy spreads, those Greek spreads, and those corporate bond spreads. These will be kind of at the front lines of any violent reaction, especially if we get faster than expected ECB tightening cycle.
All right, Bloomberg's Christine Aquino, thank you so much. Really dramatic movement we are seeing in rates markets across the world. Now let's get over to politics and over to Washington. President Biden and France's Emmanuel Macron talked by phone about responding to Russia's military buildup on the Ukrainian border. Of course, later this week, Macron is due to visit both Moscow and Kiev. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now. Anne-Marie, as Biden heads into a meeting with Schultz and Macron heads into meetings in Ukraine and in Russia, are the U.S. and France on the same page?
Well, they've spoken a lot over the past few weeks. I think it's been about 3 times since last Wednesday. And really, Kate, there's going to be a flurry of diplomacy given the fact that there are reports that Russia at this moment has amassed 70% of the troops it would need for a full invasion of Ukraine. So it's going to be today that President Emmanuel Macron will sit down with President Vladimir Putin. He's going to work on some de-escalation and try to get Putin to at least agree to continue on this diplomatic path forward. Macron's inner circle like to really paint him as a foreign diplomat that can be a linchpin in the Western allies' push when it comes to Moscow. And this really, for Emmanuel Macron, is 5 years in the making. In 2017, when he won re-election, he said that he wants to recalibrate and have reset of talks with Russia. It hasn't always worked in his favor. So this is going to be a very important meeting for him and his government. And then following that, he's going to be heading over to Kiev.
Emery, the Germans have asked to raise sanctions on Russia in every way except for the one way that matters, right, on energy. Biden wants to push Olaf Scholz, or wanted to push him on that in a meeting. What do we know?
So obviously, when Olaf Scholz, the Chancellor of Germany, sits down with President Biden in the Oval Office, the questions I imagine will quickly, and the discussion will quickly turn to, what are we going to do about Nord Stream 2? So Olaf Scholz was asked about this in the Washington Post interview last night, and he said all options are on the table, but you got a very much more direct response over the weekend from National Security Advisor Jake Sullivan, who said one way or another, if there is a further Russian invasion on Ukraine, the second half, Nord Stream 2, the last leg it needs to be operational, will not go through. That would be the end of Nord Stream 2. So the Americans at this moment are very aggressive on how they're going to use Nord Stream 2 as leverage when it comes to sanctions against Russia.
Okay, thank you very much to Bloomberg's Anne-Marie Horder, tracking the visit of Chancellor Olaf Scholz then to Washington for us, well, to the United States. Now, after a brutal fall in its share price, Peloton is evaluating potential takeover bids, but the fitness company could find a challenging climate if it opts for a deal with a big technology firm. Let's get more details from Bloomberg's Danny Berger. Danny, what do we know here?
Well, I should just say off the bat, Anna, that the market likes this one, or at least thinks it's going to go through. We're looking at pre-market Peloton up more than 22%. But if anything, this is just logical. Excluding this pre-market move, a price tag on a Peloton takeover would just be so much cheaper than it would, say, a year ago when Peloton was valued around $50 billion. Today, it's just around $8 billion. So Bloomberg reporting suggests that Peloton has hired advisors. They are looking at potential offers. Other reports suggest that it could be Nike, it could be Amazon. Dan Ives over at Wedbush saying that maybe Apple will get involved, just sort of defend themselves if other people move into fitness. But the issue here is that the regulatory environment in Washington, especially around big tech, has gotten much more icy. So our very own Bloomberg Intelligence suggesting that a Peloton deal, this company might just be too small, not worth the headache for one of these big tech firms, and just serve as a distraction.
Although they're trading at only 2 times sales, what do we know about their earnings coming out on Tuesday?
Well, they are going to be crucial if Peloton wants to bat down any of these suggestions that they're going to be bought. We had a preliminary earnings from them last month where sales miss, subscribers miss, and in that statement, the CEO really concentrating on cost, saying we're taking significant corrective action to improve our profitability outlook and optimize our costs across the company. They said that tomorrow, this earnings report would be when they detail those costs. But again, Bloomberg Intelligence says that they need to be more aggressive. It can't just just because they need to look at extreme action, maybe even M&A in their own right to really lift things up at this point, Kaylee.
All right, well, we will wait and see what those earnings results look like tomorrow and continue to monitor the shares throughout the day today. Thank you so much to Bloomberg's Danny Berger. Now, while Peloton is moving to the upside in a big way in pre-market trading, there are a number of other stocks moving as well that we should note. Matt was talking earlier about the fact that we're seeing Bitcoin gaining today, and that's reading through to pretty much all crypto-related equities, including Marathon Digital, which is up about 5% before the bell. Another stock moving to the upside is On Semiconductor. This is due to report earnings before the bell here in the U.S. today. About 8 a.m. Eastern time is when we are expecting those, and it seems that shares are getting bid up going into that print. That stock up 4% before the bell. Finally, one other stock to note is Snowflake. That is the software company. It was raised to overweight at Morgan Stanley. The price target on that stock, $390. That implies about 41% upside to Friday's close, and as a result, that stock is up about 3.8% before the bell, trading right around 286, Anna.
Hey, Kaylee, when we come back, we'll talk to Derek Halpenny, MUFG's Head of Research, Global Markets, EMEA, and International Securities. What does spread widening across Europe mean to him? How worried, how concerned should we be about that? And on the geopolitics front, Russia and Ukraine, Leslie Vinjamuri, Chatham House Head of US and the Americas program, joins us. Can Western allies really get on the same page on all of this? We'll have analysis from Leslie coming up shortly. Plus, later today, we'll speak with the Nobel laureate and NYU economics and business professor Michael Spence. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year, and I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. You know, there's a huge mismatch in supply and demand. Prices are high. You know, prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kaylee Lyons, Anna Edwards with us out of London. Now, we have seen some real volatility in the rates markets. It really dwarfs the kind of volatility that we've seen in equities. If you look at some of the moves, especially in the peripheral spreads, they're just shooting higher. It would equate to 3, 4, 5 maybe even 10 or 15% drops in equity indexes, but we're not seeing that in stocks. Justina Lee, Bloomberg Markets reporter, joins us now to talk about why that is. Justina, everyone in Europe is breathless about the moves in rates, but you're not seeing really big moves in stocks. Why is that?
Yeah, that's really interesting because, of course, we've seen a bit of a correction, but I think based on kind of the chart that you just showed, it seems like it's nowhere, kind of close to what potentially we could see later. I think one reason is because generally investors are still pretty happy with the state of the economy right now. I mean, we can see that from last week's U.S. jobs numbers. On one hand, yes, people got more worried about rate hikes, but on the other, it does show that the economic recovery is still trudging along pretty nicely.
Yeah, it's interesting. On that subject, I'm just looking at a piece from our colleagues talking about Bank of America's view, saying equities are unlikely to lose their attractiveness relative to bonds anytime soon, particularly in Europe. That's the view over at Bank of America. But in terms of the higher rates environment, Justina, it isn't just a U.S. story. It's not just a European story. It's global, of course, with the exception of China. If you look on a map at parts of the world where we're seeing holds and hikes, obviously China stands out as a place where we're still seeing looser monetary policy. How do we play that divergence?
Yeah, that's interesting because even now we're hearing kind of noises about monetary tightening, even in Europe. I think in China, they're kind of on a very different path now. And of course, given the sharp discount that we're seeing on Chinese stocks right now, it would be interesting to see whether investors are moving back to that region, especially if they get a little bit less worried about the regulatory picture over there.
Justina, obviously we're all focused on the macro picture, on the prospects of policy tightening across the world. We're still also in earnings season. Does it matter at all?
I think in a way it kind of matters even more because, like I said, one kind of solid backing for the stock market right now is that if, investors are seeing earnings numbers that they like, it might kind of support the market in the sense that, sure, rates are going up, but at least kind of the economic picture is still looking well. And I think for now, it does seem like that support is still there.
So what kind of earnings are we expecting for this quarter, and what kind of earnings are we expecting throughout the year? I mean, is inflation going to be a big damper on margins?
Yeah, I think it kind of depends on what companies we're talking about. And we're really seeing kind of from the moves in the past few weeks that markets have become a lot more sensitive to disappointments. I mean, that's quite apparent, if you contrast the Facebook results with the Amazon results. It's not like, Facebook is not growing anymore, but, with those multiples already so high, people are very sensitive to any kind of letdowns.
I was talking to our colleague from Bloomberg Intelligence earlier on around the earnings season, and one of the phenomena he was pointing out was the buildup in inventories we're seeing, and it might be, you can compare it back to 2019 and the levels we're seeing there. Part of it might be this sort of bullwhip effect. So companies go through phases, don't they, of ordering a lot of stock and then not much because they're really uncertain about demand levels right now through the pandemic. But also he was suggesting, we're moving from maybe just in time to just in case, and that means companies build up these inventories, which is going to weigh on balance sheets.
Yeah, that's interesting because the lesson I think a lot of companies have learned kind of in the past few years that sometimes supply chains are not kind of as reliable as you think. And of course, we've seen very strong consumer demand even during the pandemic. And now it seems like some of that has kind of kept quite solid.
Okay, Justina, thank you very much. Bloomberg's Justina Lee joining us here on set in London with thoughts on market moves. You can get up-to-date analysis on all of the market's latest movements. MLIV Go is the function to use on your terminal to stay across the Market Live Teams blog. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now let's get the first word news. And a state of emergency has been declared in Canada's capital over a protest against vaccine mandates and COVID restrictions. Hundreds of trucks have been parked in downtown Ottawa near the Canadian Parliament. The city's mayor says that increasingly rowdy demonstrations pose a threat to the safety and security of residents. President Biden's top advisors are repackaging his economic message to the American public. That comes at a time when his approval ratings are sinking and his legislative agenda stalls in Congress. In the last week, the president has put more emphasis on growth in wages, union jobs, and domestic manufacturing. He's giving less weight to areas that are sore points with voters, such as inflation and the partisan strife over COVID. In the UK, a no-confidence vote on Prime Minister Boris Johnson could come as soon as this week. A minimum of 54 Conservative members of Parliament would have to support a vote, and the Sunday Times reports that some predict the total is approaching that. One Conservative lawmaker tells The Observer, quote, "It is going to end in him going." Over the weekend, Johnson filled 2 key positions after senior aides quit. And the CEO of Spotify has apologized to staff for the controversy over Joe Rogan's podcast. Rogan is under fire for making racial slurs and spreading COVID misinformation. But Daniel Ek says he still doesn't agree with calls to drop Rogan from the streaming service. He says Spotify will spend $100 million on content from historically marginalized groups. So, Anna, that drama continues at Spotify. My question is, how much pressure will continually be put on Spotify from other artists, and do they have to change their tune when it comes to Joe Rogan?
Yeah, we'll see if the current line of argument holds. What is clear is the big leap it is from a management team to go from streaming music to putting out podcasts where you're, on the music side of things, you can categorize the lyrics based on whether there's any particular language in there that people might find offensive. But that's a relatively simple issue compared to what they're having to deal with now. Incredible story to watch. When we come back, we'll get back to the markets conversations. Eric Halpenny, MUFG, Head of Research, Global Markets, EMEA, and International Securities joins us. We'll ask him about this global higher interest rate environment we seem to be talking a lot about this morning. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
From New York City,
in London, in Sydney,
in San Francisco,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this How story. How are you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York, and here's what you need to know. The global bond rout is spreading. The strong US jobs report stoked expectations that central banks around the world will be aggressive when it comes to raising interest rates. Traders see a 40% chance the Federal Reserve will kick off rate hikes with the sharpest increase in 2 decades in March. President Biden and France's Emmanuel Macron talked by phone after responding to Russia's military buildup on the Ukrainian border. This week, Macron is due to visit both Moscow and Kiev. Meanwhile, Germany's Chancellor Olaf Scholz will have his first meeting with President Biden since taking office. Now, shares of Peloton are soaring today. The company is said to be exploring takeover options. There are reports that both Amazon and Nike are considering making offers. Peloton stock has fallen more than 20% from the high a year ago. It's a little bit higher in pre-market then. Let's take a look, that is a look at what you need to know. Matt, what are you focused on then as we head towards the start of another trading week?
I'm focused on what kind of moves we're seeing in S&P futures here, Anna, because they don't seem severe compared to the jumps that you've seen in peripheral rates, the jumps that you've seen in the U.S. 10-year yield, the jumps that you've seen in NYMEX crude, although it's down right now. Look, S&P futures bouncing back and forth a little this morning, mostly on the downside, but only 0.2% after finishing last week with a gain on Friday, 0.5%. Meanwhile, yields shot up. We're over 190 on the 10-year. We're well over $90 on NYMEX crude. It's coming off a little bit, but still holding at that level. And Bitcoin is rising more than 2% to 42,533. So it doesn't look as disastrous in the U.S. pre-market as it does when you look at peripheral yields in Europe. Kaylee, what are you looking at in terms of pre-market movers?
Well, Matt, I'm watching the Peloton story that Anna mentioned, of course, reportedly exploring some takeover interest because, honestly, it's a much more attractive target now than it was, say, when it hit its record high, which was some 80% ago. It is down that much since the record it reached, though it is recovering some of that this morning. It's up about 24% in pre-market trading. A lot of optimism potentially about that takeover. Another stock moving to the upside goes along with Bitcoin moving higher, as you mentioned, Matt, and that is MicroStrategy. Basically, all crypto proxy equities are moving higher today. It is up 4.7%. A few stocks moving to the downside to note, though, one being Alibaba. It filed to register 1 billion previously unregistered shares when it comes to those ADRs here in the U.S. That to Citigroup is a sign that maybe SoftBank is getting ready to sell some of its stake. We saw Alibaba shares down in Hong Kong as a result, and those ADRs are down in pre-market trading here in the U.S. by about 3.7%. And one other stock moving to the downside again is Toll Brothers. This, of course, is a home builder. It's already down 20% 25% year to date as we see expectations for tighter Fed policy, which could ultimately lead to higher mortgage rates and slow down the housing market as a result. It is adding to those losses this morning, Anna, down about 4.6%.
Yeah, and the changing role of the Fed in the mortgage market as well, we're thinking about there. Kaylee, let's focus in on what we've seen here in Europe. And to Matt's point about how we're seeing quite a lot of volatility in spreads in the periphery of Europe, in the bond markets, and that's not necessarily leading to everybody throwing away the TINA model right now. So there does seem to be some appetite for stocks, even quite muted. Right now, we're fairly flat, I suppose, across European equity markets. Some areas getting support from the mining sector. So areas like London, where you do see a heavy presence of mining stocks, and those higher commodity prices have been helping and continue to do so this morning. This is the spread widening we're talking about, though. This is Italian BTPs over bunds, and we have seen this spread widening up to 162 here. It's not just Italy, it's Greece as well, and a lot of people talking about how traders are kind of reaching for that Eurozone debt playbook here when it comes to European peripheral spreads. Reckitt Benckiser, interesting to see what kind of pushback we get then from the ECB, if there is any, and therefore maybe these moves have been overdone. Reckitt Benckiser, a consumer goods company here in the UK, that stock up 0.4%. There was a great Bloomberg scoop at the end of Friday talking about how they might be about to sell their infant nutrition business. And Faurecia makes car parts, car spares and the like. And they've done a deal with one of their German rivals. They bought that business, combined the two, and they've renamed themselves today. And the new targets have gone down well, with investors up by 2% and a bit. Kaylee.
All right, Anna, well, I'm continuing to watch that bond story that you mentioned. Obviously, we're seeing spreads widen, a dramatic sell-off in the periphery. Just to put it in context, the 10-year BTP yield right now is 1.85%. That is some 55 basis points higher than we were Monday a week ago. So let's get more on these dramatic moves. We are seeing the repricing of expectations when it comes to the ECB. Joining us now is Derek Halpenny, Head of Research for Global Markets, EMEA, and International Securities at MUFG. Derek, are these moves overdone at this point, or do we still have further to go?
Well, I think you've got to take this in the context of what was a very significant pivot from the ECB on Thursday. And the scale of that the shift in rhetoric, I think, has prompted this pretty aggressive shift in positioning. You know, it's logical and it's understandable given the timing of that support in terms of ECB buying through PEP and APP could come to an end sooner than expected. And I think that's a reflection of the price action we're getting. I wouldn't necessarily say it's problematic at this point. Of course, the scale of the move is very, very significant. And of course, it will be something the ECB will be looking quite closely at. But it makes sense. And I don't think the ECB would be hugely surprised by the way in which the markets have reacted to what was said by Christine Lagarde on Thursday.
Good morning to you, Derek. We see, yes, that the spreads is what we're talking about here. We also see equity markets reacting a little bit to this. FTSE MIB, for example, down by 1.6%, and there could be some read across, although it's a little more complicated, some oil stocks to the downside as well. Do you think the ECB would want to push back against the speed of the move here, or the way that these concerns are being expressed with the peripheral bond spreads? You know, that the ECB very alert to not wanting to widen those spreads unnecessarily, perhaps.
It's a tough task. Like Lagarde speaks this afternoon, so let's hear what she says today. But you know, there's no getting away from the fact that the ECB has pivoted. Now they can balance that up to some degree, and of course, I think what's priced into the rates market from by the end of this year, I think, is excessive. But I think, you know, rates in the UK are excessive. I think rates in the US are probably excessive. But we're in a current market mindset of investors, I think, essentially not believing the communications about contained moves, because essentially, if you look back over the last 3 to 4 months, central banks have been playing catch up to the reality of what's happened with inflation. And therefore, whenever there's a pivot, the markets are going to overreact because they're pricing in the prospect of another pivot.
So does the market think you were late, therefore we don't believe you now when you say you'll be slow?
Yes, essentially the risks are that the ECB will have to pivot again if inflation remains higher than expected. So of course, everything about trading for investors is timing. So I think at some point this year, there will be a point when that can readjust. But we have another couple of months of inflation that's probably going to be more to the upside than to the downside. And we need to get through that period. We need to get through the first rate hike from the Fed, a couple of other kind of moments to get through before we start to see inflation falling back again. And then perhaps some logic can come into the markets about whether or not we need to have that extent of aggressive tightening going forward.
But Derek, we have a great picture of the balance sheets of the big four central banks, and they're holding more than $25 trillion worth of debt on their balance sheets. If they start to unload this, and Andrew Sheets at Morgan Stanley thinks that they'll reduce by about $2 trillion between May 22 and May 23, what kind of effect does that have on financial markets?
Well, the extent of liquidity injections because of the pandemic was unprecedented. And most importantly, the broad-based actions from G10 when it came to balance sheet policy, that was very different. Global financial crisis was much more G4. So, the reversal of liquidity is going to be significant. And I think that's where you're getting some of the reactions in the rates markets. Like our view in terms of maybe later in the year, investors start to question the extent of what's priced into the market. I think that will follow evidence of the very difficult, challenging financial market conditions and much higher volatility that's going to come. And that in itself has important implications for the real economy. Let's face it, the financial markets tied to the real economy is very, very significant.
Yeah,
more significant than before.
And that's absolutely what I'm getting at here, Derek. I mean, a lot of companies have positioned themselves for lower rates for a lot longer, right? And there are going to be companies that can no longer borrow at lower rates. There are going to be companies that can no longer borrow at all. How significant is that effect going to be on the real economy?
Well, you're talking about companies that can no longer borrow. Of course, that's hugely problematic. I'm not sure we're going to get to that state this year. Again, our assumptions are that at some point, summertime, we're going to have a readjustment in terms of the extent of tightening that's priced. And of course, part of that on the rate side is because of what will be unfolding on the balance sheet side. For certain corporates, it's going to become a lot more difficult. But we also shouldn't forget the corporate earnings results that have come out to date. I think one of the surprises has been the way companies have been able to manage the inflation spike so far and the way they've been able to manage through the pandemic. So the corporate sector and the balance sheets of the corporate sector are pretty healthy in many of the major economies. And that will help, I think, diminish the immediate negative impacts of what's happening in the rates market.
Yeah, I was talking to one colleague from State Street earlier, Derek, who was making the point that those balance sheets are healthy and we could still have a capex cycle, even as central banks pull back, more capex to invest around. So certainly something to watch. Yeah. Derek, thank you very much for joining us. Derek Halpenny, Head of Research for Global Markets, EMEA and International Securities at MUFG. Thanks to Derek for spending time with us. Next up on the program, Leslie Vinjamuri, Chatham House, Head of US and the Americas program, will be with us. We'll talk geopolitics, tensions between Russia and Ukraine. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the House for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Our current situation is very turbulent, but I believe that with support of our international partners, we can be able to move further. First, I want to thank all our international partners from United States to British, France, that are able to build up a strong support from Ukraine. First, it's a IMF program, then it's a MFA program from European Union, and also it was mentioned Canada, Germany, France, and other partners that are doing their best to support Ukraine.
That was Ukraine Finance Minister Serhiy Marchenko speaking with me a little earlier on today. Joining us now for more on Ukraine tensions is Leslie Vinjamuri, Chatham House Head of US and the Americas Program. Leslie, good morning to you. Great to have you with us. And we should say, we keep saying that Russia has said repeatedly that it has no plans to invade Ukraine. Also, when I spoke to the Ukrainian Finance Minister, he said to me, Leslie, that it's not necessarily, he was talking about financial support that they might be seeking from Western allies. He said it's not so much the amount of money that might be available, but the message that it would give. I suppose a country like Ukraine, whose economy might have been suffering at the hands of deteriorating expectations based on this tension, they will be grateful for any kind of signal that would be provided by Western support.
Absolutely. I think you're exactly right. The need right now for Western unity couldn't be greater. We see the German Chancellor traveling to Washington. He's in Washington now to meet with President Biden today. That is a very important set of meetings because, of course, Germany has been seen to be not strong and united as much as the United States and others would like it to be. And Russia sniffs this out. China sees this. We saw the statement just a few days ago from Russia and China, which are clearly showing tremendous unity. So I think for Ukraine and for the general stability of the situation, having that on any number of questions, but just generally is incredibly important to the ability of the U.S. and its partners to really deter the potential for Russia's future aggression.
Well, on the subject of Ukraine, Leslie, we are just getting some headlines out of the Ukrainian foreign minister who says he will continue to ask Germany to approve weapons supply and that Germany's current stance on weapons supply to Ukraine is, quote, not fair. How difficult is this challenge for Olaf Scholz to navigate as a new leader of Germany post-Merkel era?
Well, this is clearly very difficult for Germany in general. It's particularly difficult for this chancellor who's facing a lot of division on this question within his own coalition, within his own party. Not an easy thing, of course, for Germany to approve export of lethal aid in any case, but going so far as to block other partners from sending those weapons to Ukraine, I think, is a real sticking point and a source of potential division within the alliance, and also something that symbolically as well as in real terms, of course, is very difficult for Ukraine. So I think that this is one of the key issues for Germany. The other one we know, of course, is its position with respect to whether Nord Stream 2 would be considered in that sanctions package, and the EU is working very carefully, as is the U.S., to pre-approve or pre-agree a set of sanctions that could be approved were there to be an invasion or violation of Ukraine's sovereign borders.
If there were an invasion of Ukraine's sovereign borders, would European countries continue to pay Moscow for gas?
Well, this is, one of the key questions here, right? And
would they have any other choice, Leslie?
Well, I think the move right now is to try and develop alternatives, right? Alternative sources of energy. It's very difficult to get those to the level that they're needed. This is clearly an immediate problem, but it's also a medium and long-term problem for, the energy transition in Germany. So this and the question of sanctions on Nord Stream 2 is this is why it's so difficult. And I think we're going to see that conversation. We probably won't see it visibly. We'll see it discussed. It will be discussed in Washington today. And we saw the interview that was published by the Washington Post with the German Chancellor, where he talks about the need for strategic ambiguity. In other words, he's not going to be pinned down on this question of sanctions for Nord Stream 2.
And you talked there about diversification of energy supplies, Leslie, which sounds like much more of a longer-term initiative. In the very short term, we understand the US has been talking to all kinds of different players around the world to try and assess if there's any way of supplying further energy to Europe should it be needed. But there aren't alternatives, are there? And so Germany will continue to plough this course of strategic ambiguity, as you describe.
Absolutely. It's a very difficult position to be in. It's difficult for the West, and it's a political and daily reality, potentially, for Europeans in the face of a difficult winter. And a highly dependent energy situation. It shows,
Leslie,
right, as
so
we've
much.
seen. Thank you.
No, finish your point.
It just shows that we're now in a situation, whether it's with China or with Russia, where there are deep dependencies globally amongst partners that simply don't have the same security interests, don't share the same values, and where tensions right now are extremely high, and the situation is very dangerous.
Leslie, thank you very much. Leslie Vinjamuri, Chatham House head of US and the Americas program. Coming up later today, former US ambassador to Germany, John Emerson. That is at 10:30 a.m. in New York, 3:30 p.m. London time. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London. Tom Keene is the co-anchor of Bloomberg Surveillance, and he joins us now with a look at what he's watching to kick off this week. Tom?
Less data coming off the jobs report. You see less data, Matt, than you're ever going to see. But I think there's really been a sea change here. It's identified over the weekend, and a lot of the research we'll go through today on Bloomberg Surveillance. But that is, the negative yields evaporate. And as you well know, mostly in Germany, where you've lived, negative yields. And, you know, the real question for me, Matt, is how will this change commercial banking in Europe? It's something David Folkers-Landau at Deutsche Bank has talked about for years. Let's go to the chart. It's a chart a lot of people have shown here recently. Nothing original here other than the plunging amount of negative yielding debt really getting back through 2017 and back to 2014 levels.
Tom, we're also going to hear from Christine Lagarde later this morning. What does she need to say and or not say to this market?
I think you're dead on. It's a type 2 construct. It's what she doesn't say. It's going to be fascinating to see, as John Farrow, who's better at this than I am, mentioned, what a shift we saw from even the transitory headlines of the other day to the press conference. And it's going to be interesting to see how she reaffirms that or if she just avoids it.
Yeah, absolutely. So peripheral spreads very much in focus here, Tom, in Europe, but also U.S. inflation will be in focus later on this week, and we have that report due Thursday, I think.
Yeah, it's an important statistic, if not the statistic of the week, as we continue earnings in America. What I would suggest underpinning this, Anna, in America is everyone's attention to rent and housing. J.P. Morgan did a fabulous effort Friday evening on housing. Michael Ferroli over there just did a great tear apart of housing, and he looks for housing pressures and price pressures to continue.
All right, definitely going to be paying close attention to that. Tom Keene, co-anchor of Bloomberg Surveillance, thanks very much for joining us. Look forward to the program. Let's get to what else we're watching, and I'm paying attention to the Biden meets Schultz story, even as we talk about strategic ambiguity, which is, I guess, a phrase that means Biden or Schultz doesn't have to tell Biden what he already knows, which is that they're dependent on Russian gas, and they don't really have any other choice. I mean, even if we ship all of our LNG to them, it's going to take a while to get there, and that's not going to be enough for Germany's needs. I'm also, by the way, watching this Peloton story, Kaylee. The idea that this company was once worth $50 billion is pretty shocking now that it's trading for $8 billion. And that's a serious discount if any suitors decide they want to pick up the exercise bike company.
Yeah, down 80% from a record high, though it's up 24% in pre-market trading right now, so it's definitely gaining some of that back. I am watching what we were just discussing with Tom, ECB President Christine Lagarde speaking later on this morning, 10:45 a.m. Eastern, 3:45 GMT. She's going to be giving the introductory statement at a hearing of European Parliament's Economic and Monetary Affairs Council committee. As we were saying, is kind of about what she doesn't say, given she said a lot on Thursday that changed the market's mind about the trajectory of monetary policy in the euro area. So does she try to walk that back somehow today, Anna? Yeah. It'll be interesting to see, especially for this bond market.
We've heard from the Dutch ECB leader, of course, Klaus Knot, who talked about the fourth quarter of this year being a possible for rate hikes. The market seems to think September could be, so third quarter, fourth quarter, we'll see what she has to say, if anything, about timing. But linked to your story then, very much, Kaylee, looking at these bond spreads, peripheral bond spreads, 163 for Italy BTPs, Greek debt, also the spread widening there, 225. We're told by colleagues that's in a low liquidity environment, but will Christine Lagarde decide to push back against any of that spread widening? She has perhaps confused the market in the past with her views on the spread, so we'll certainly be paying attention to that. More Bloomberg Surveillance is ahead.
going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Absolutely think that this is the year of the stock picker.
You have to look for those companies with sustainable growth and market opportunities.
I would want to make a distinction between, unprofitable tech companies and other growth areas of the market that are profitable.
I think the frothier areas of the market will continue to have headwinds.
I think we have to all sort of fasten our seatbelts. It's going to be a volatile ride.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Big week coming up from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market down about 1/3% on the S&P. TK, some big moves in this bond market.
Big moves in the bond market, and we really recalibrate. John, I nailed that jobs report. It was just amazing.
Didn't we all, Tom?
I got that right. I spent the whole weekend recovering.
Can you nail the CPI report as well, TK?
I'm going to nail the CPI report as well. What we know is we're adjusting in real time. And John, to me, the story within yield space is in the equity markets where you've got bears and you've got bulls, and they are far apart.
Let's look to Italy as well, Tom, and look at the move in the Italian debt market. We've gone from negative 17 basis points at the open last Monday on a 2-year to positive 46. Blink of an eye. Today, up another 13 basis points. Does that get the attention of President Lagarde?
It's got to get her attention in the comments today. The big shift that we saw Thursday, Kayleigh Lyons just talking that up. John, I look at Italy. It's got the economy about the size of Texas, and it's a bellwether. John, explain to our audience waking up in America, why does Italy matter?
One of the biggest debt markets on the planet, Tom. It's had the support of the ECB for a long, long time, and that support's going to get pulled away over the next 12 months if the guidance from this ECB is anything to go by.
Commercial banking in Europe's going to be fascinating, folks. This has been a theoretical experiment. What's the one day when negative yields become positive yields? Frankly, John, we're here.
Well, even the most hawkish member of the ECB, Lisa, I thought this was important. Klaus Nod of the Netherlands is teeing up Q4 for a rate hike, 25 basis points, and then again 25 basis points in the spring of 23. That's not exactly a hawkish path from this ECB. What we're grappling with is we're going from nothing to something, and it's a big change for the Europeans.
And we're going from worried about keeping markets calm to more worried about inflation possibly. And I think that is the pivot point that really got the market's attention last week with ECB President Christine Lagarde, that they are now more concerned broadly about inflation, which means are they going to act as the same put on those Italian spreads that you're talking about, John?
Do you like that line from Andrew Sheets of Morgan Stanley over the weekend into this week? It begins. it begins.
Well, and to put some context on that, they expect from May of this year to May of next year an estimated $2 trillion to come off the balance sheets of the 4 biggest developed market central banks. The idea of quantitative tightening like we've never seen, at least in the recent era. How do markets respond given the turbulence and given what could potentially come?
And that's what we're wrestling with right now. Your equity market down 1/3 on the S&P, on the Nasdaq 100 down 0.25%. Into the bond market, yields higher on a 10-year to 192. It's been a while since we've been comfortable in the 190s. Here we go again, 192.13 on twos. Up again last week. 7 weeks of gains for a US 2-year yield. We've talked a little bit about Italy. Got to talk a whole lot more about the Treasury market. And euro-dollar, Lisa, pulling back 0.25% on that currency pair, 114.24.
I don't envy FX traders right now trying to put into perspective all of these different conflicting moves. Really, this is a countdown to Thursday kind of week. We're going to be taking a look at the CPI in the United States, but today it's very much geopolitics front and center. 1:30 p.m., German Chancellor Olaf Scholz is set to meet with President Biden, his first meeting since overtaking the position from Angela Merkel. We haven't really heard that much from him in terms of his agenda, not only with respect to Russia, but also with respect to inflation. And if you take a look at break-even rates over the next 2 years, they have climbed to the highest in decades in Germany, to more than 2.5%. How does he combat this at a time when there are so many geopolitical concerns about oil and the potential for sanctions on Russia? Today, U.S. Secretary of State Antony Blinken leaves for a 6-day trip to Australia to meet with Quad counterparts, part of a trip to show unity with the Indo-Pacific regions and nations against China. This, again, what an interesting time. You've got China and Russia kind of working together with some sort of relationship with Ukraine, but also with the backdrop of the Olympics, where everyone's playing nice and getting together and playing kumbaya. It is a very strange dissonance right now. At 3 p.m., the Federal Reserve is going to report U.S. consumer credit for the month of December. We saw it skyrocket to the highest level in years at the last November meeting. December reading will be interesting, John. How much are consumers starting to borrow again as they deplete some of their cash piles? Or does this indicate perhaps a lack of confidence of the consumer if we do not see that increase in borrowing?
Did you watch any of the Olympics whatsoever?
I did not. I did not, but I read some of the headlines, and I've got to say I was really struck by the quarantine camps for some of the athletes and questions around some of the supplies given to them during those quarantine periods. A lot of question marks for me.
I didn't watch a single minute of it either. Lisa, thank you very much. Looking ahead to the data this week on Thursday, CPI, Tom, 7.3%, the median, the high 7.6, the low estimate 7. A lot of people think this is going to have a 7 handle again.
John, as you know, and I think our audience has a good understanding of this, particularly global Wall Street, there's ways that you read research. And this was a weekend, John, after the tumult of last week, where I really sat and read every word of the research. And what's fascinating is what this inflation report tells us about the importance of future inflation reports. Do we begin to embed 7 or 6 or 5% inflation?
Let's talk about the research from RBC. Laurie Calvasina, the head of U.S. equity strategy at RBC Capital Markets, joins us now. Laurie, you say 5 good things we're seeing in the data right now. Can we start with the good stuff? Let's start there.
Sure. I think, one of those we're right smack dab in the middle of right now. Earnings are holding in. And actually, we put out something over the weekend where we talked about how we've actually seen earnings estimates move up a little bit for this year and next year. Complete opposite of what a lot of people were fearful of a few weeks ago. I would say another thing that's really good right now, John, I think that we've largely priced in a more aggressive Fed. Now, we haven't priced in the economic damage that an aggressive Fed might incur. But if you look at the multiple contraction we've seen year to date, it's been about 17% at the January lows. That's right in line with the average of the last 5 or 6 Fed tightening cycles going back to the 1990s. So I think the Fed is basically in the market right now. Again, if the Fed damages the economy, we still have to price that in. And then I would lastly just give you AAII net bullishness. A couple weeks ago, we got down to levels that were actually below 2020 lows. Let that sink in for a second. But what we've seen historically is that when we get below minus 10% on a 4-week average on the net bullishness, so the bears outnumber the bulls by 10% or more, you see a 15% pop in markets over the next 12 months. So that's something else that's telling me that we've priced in a lot of this bad news from the Fed already.
Lori, Ben Laidler over at eToro calculates out a 26% lift in earnings. He makes a note that it's coming in again better than expected. Can you already model that confidence forward? Can you construct this morning a confidence in earnings for this Q1?
So I think that Q1, as I've read through transcripts, it seems to me like it's going to be a messy quarter. Now, we haven't really seen companies, sit here and say things are a disaster, right? Like if you look at the consumer in particular, people are being vigilant. They're watching the low end. But I would say that the confidence level does seem to me a little bit shakier than what we've seen, sort of the past few quarters, whether you're looking at demand, whether you're looking at reads on confidence, less uncertainty. I would say there's maybe a little bit more, kind of nervousness right now. But by and large, companies are being given the opportunity to kind of reset expectations in a nasty way for this year, reset expectations in a nasty way for the quarter, and they're simply not doing it. They're still telling us that demand is generally okay, even though, we've come through a little bit of a rough patch and they've maybe had a little bit more trouble than usual dealing with that.
Is there a sense, Lori, of how much pricing power these corporate executives feel they have?
It's a great question, Lisa. And we actually use the Bloomberg Transcript Analyzer tool. I'm going to give you guys a little bit of a plug. It's a fantastic tool. And we did a search on pricing. And we found that it's absolutely spiked so far this year. It had been moving up last year, and we've seen a really big spike this year. And I've noticed that, frankly, as I've gone through the transcripts, maybe a little bit less discussion on supply chain, obviously a lot of discussion on labor. That seems to be the new big issue right now. But pricing's been much more in focus in a way that we haven't seen in the past. And I would tell you, even companies that are expressing a little bit of concern about the low-end consumer, they're saying, we're going to manage pricing very careful. We're taking as much as we can get, but we'll pull back a little bit if we feel like we need to.
The other side of the market that actually started delivering something for me last week was the banks. Banks had a massive week last week, Laurie. Finally starting to see higher rates translate into better performance for US banks. Do you see that continuing?
It's interesting, John, because we've seen that banks actually start in the financial space broadly. They weren't cheap anymore coming into this reporting season. They had a repricing, for about a week or so. And the news has generally been fine outside of the higher comp expenses. So I think we kind of got some of that bad news out of the way. We reset the expectations on the valuation side, and it's allowed, sort of the good fundamentals that are in place right now to propel the banks higher again. So we'll watch for that to continue a little bit longer. I was a little bit concerned that we wiped out the valuation story so quickly to start the year, but it's back, so let's enjoy it as long as it lasts.
Laurie, thank you. As always, Laurie Calvasina of RBC Capital Markets. Lisa, that move on the banks last week, a move of 4% for that sector.
Yeah, there's an idea of the real yield going higher, actually, or less negative, I should say, being a real positive for the banks. Issue for me is how much are consumers continuing to remain able and willing to spend at a time when their dollar goes less far, and frankly, real wages aren't keeping up.
You mentioned yields. Lisa, you've been on top of this story forever, for as long as I've known you, the pool of negative yielding debt. Tom Keene, the move that we've seen in the last couple of days, the team here at Bloomberg doing a calculation, we had nearly $3 trillion wiped off of that pool of negative yielding debt in just 2 days last week. That stockpile's down to below 5. Just underneath 5 trillion, just a little less than 5 trillion, Tom, after being, close to 20 a couple of years ago?
Well, I just featured that chart on TV here about 40 minutes ago, John, as you were coming in the door. And all I can say is we're not back to zero yet, but it's amazing the descent, the plunge almost is the right way to put it. We're all looking at certain things. John, you got to look at the German 2-year as the mother of all benchmarks there.
Tom Keene, 427. What time was I in? You're at 4:27.
You can tell?
At 4:30. You did beat me into the door this morning by about 3 minutes. I'm pretty sure Lisa beat us both. I think Lisa has a 3 handle. Lisa's definitely got a 3 handle.
Do you mean they can tell? I
can check, Tom.
Literally, John is checking.
I've got the access
in real time
for the team.
Oh, you have the access.
You don't have that access. Futures down a third of 1% on the S&P, and the Nasdaq 100 down a quarter of 1%. I get alerts if he's late. Yields up a basis point on 10s to 192.13 from New York City. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. In the UK, a no-confidence vote on Prime Minister Boris Johnson could come as soon as this week. A minimum of 54 Conservative members of Parliament would have to support a vote, and the Sunday Times reports that some predict the total is approaching that. One Conservative lawmaker tells The Observer, quote, it is going to end him going. Over the weekend, Johnson filed 2 key positions after senior aides quit. President Biden and France Emmanuel Macron talked by phone about responding to Russia's military buildup on the Ukrainian border. This week, Macron is due to visit both Moscow and Kiev. The US and the UK say Russia has now massed almost 130,000 troops near Ukraine. Russia denies it has any plans to attack. A state of emergency has been declared in Canada's capital over a protest against vaccine mandates and COVID restrictions. Hundreds of trucks have been parked in downtown Ottawa near the Canadian Parliament. The city's mayor says that increasingly rowdy demonstrations pose a threat to safety and security of residents. Australia is reopening to international visitors after 2 years. That ends some of the world's toughest border controls that were introduced to stem the spread of the coronavirus. Tourists and visa holders that have been vaccinated at least twice will be allowed to enter the country. And shares of Peloton are soaring today. The company is said to be exploring takeover options. There are also reports that both Amazon and Nike are considering making offers. Peloton stock has fallen more than 80% from a high a year ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
We believe that there is a very distinct possibility that Vladimir Putin will order an attack on Ukraine. It could take a number of different forms. It could happen as soon as tomorrow, or it could take some weeks.
That's the view from the National Security Advisor, Jake Sullivan, from New York City with Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Your equity market down 0.2% on the S&P. Last week on the S&P, the best week of gains on the S&P 500 of the year so far in Europe. The Stock 600 has been down for 5 straight weeks. Keep an eye on what's happening in the European bond market and equities too. For the single currency, the euro negative 0.2%. Euro dollar, Tom, 114.24.
And Zero Hedge did a nice write-up of Goldman Sachs flow data. They put out their flow thing like every week, every 10 days or so, John. And I don't have a strong opinion here, John, but Europe, equities, I don't know what to do with that.
Well, I would keep an eye on 2 things, Tom. The euro and banks. Away from the BTP market, the Italian debt market. If you start to see Italian yields rise, the euro weaken and banks roll over, we've got a problem. And that would be the thing to keep an eye on, I think. And the euro's just come off the back of its best week of gains since March 2020.
Yeah, 114.25 on euro right now, sort of middle tendency off of the guesstimate of a 116 or a 112 at that. We turn our attention right now in the jumble of news over the weekend, front and center, yes, Ukraine, Russia, the United States, and 14 other countries. Anne-Marie Horton summarizes for us, our Bloomberg Washington correspondent. The lead here from the gentleman from Germany is united and decisive. Anne-Marie, are they united and decisive at the White House?
Well, you probably were reading through his Washington Post interview, Tom, overnight, where he said all options are on the table. When it comes to the White House, they were pretty much more direct over the weekend with what the sanctions package would look like. A step that we have not really been very clear on the German side. And that I really want to come down to, which is the fact of Nord Stream 2, which I imagine the conversations today in the Oval Office will quickly move to. You had the National Security Advisor, Jake Sullivan, saying that if there is a single Russian troop headed over that border, that will have swift, severe sanctions, and that means there's no further progression on Nord Stream 2. We have yet to hear that kind of clarity from Olaf Scholz, the chancellor, who is now in Washington, D.C.
What is our ability or update to move any form of hydrocarbons across the Atlantic? I haven't seen a good summary of, we can do it by such and such a date. Does it exist?
Well, that's what they're working on, and they're in discussions with not just American LNG producers, because that's what it would be, shipping LNG over to Europe, but also others, Qatar, Libya, Egypt. There's a number of little things the administration could do, not one big package. Okay. You also have to remember that Europe doesn't have mass storage for LNG. This is not the easiest of the hydrocarbons to store. They don't have a ton of it because they use pipelines. So it would be a Band-Aid, as I would look at it, Tom, in terms of how much LNG they could get to Europe to fill that hole if Russia was to cut it off.
It seems to me that the focus is always on the President of the United States for good reason, but today, Anne-Marie, this is about Chancellor Scholz to tell us what he stands for. We've got to work that out because we still don't know the answer to that.
Yes, we know exactly what the president stands for. The Merkel administration and when she was chancellor, they really tried to lobby Washington to not put sanctions on Nord Stream 2. Now you have Olaf Scholz, who in his own press at home is getting very criticized, very much so. There's a headline over the weekend saying, "Where is Olaf Scholz?" It's a very difficult position for him. Domestically, his party was one that really wanted to engage in Russia. We talked about the business ties between Germany and Russia, but many in his own party think that potentially he's not talking tough enough when it comes to Vladimir Putin. We know that Germany will not send military equipment to Ukraine, and we've yet to hear him talk about that, yes, Nord Stream 2 is 100% a use of leverage point and will not go through if those sanctions, if there is a Russian incursion. I would bring you to one comment he made a few weeks ago in German press was that they have to be prudent. This was what he said, prudent when it comes to sanctions. And no one should be under any illusion that harsh sanctions on Russia will not have any blowback on others.
How are the allies handling the Russia-China nexus, the idea that they're working more in tandem throughout this crisis?
Well, at the moment, you have the allies all really trying to court President Vladimir Putin as well. We should note that while Olaf Scholz is going to be here in Washington, D.C., you have President Vladimir Putin heading over, President Macron heading over to Moscow to sit down with President Vladimir Putin, who just met with Xi Jinping of China at the Beijing Olympics. It's an interesting situation because you have Moscow and Beijing forming closer ties, and part of that comes at a timing when, of course, the West is, one, trying to clamp down on Russia, but at the same time also be able to talk tough on China. So a lot of this signals to what potentially could be a precarious future for Beijing.
Did you see it was Jay Powell's birthday on Friday, Lisa? Did you miss that one?
I missed it.
I forgot to mention, we should be careful about birthdays and make sure that we don't miss them and say, happy birthday to Anne-Marie.
We should.
I promised AMH I wouldn't do this, Tom, but
are we going to sing?
These moments are important. This is a big one for AMH.
Anne-Marie's literally like, I'm going to run away now, and we're going to start singing, and she's actually
Anne-Marie, why are you at work on your birthday?
Really? That's where you're going?
I came to work on my birthday because the past 6 months when Olaf Scholz was here, I was able to have 10 minutes or so with him. So I didn't want to miss his visit as he's chancellor.
Does Chancellor Scholz know this, that you've turned up on your birthday to make sure you get an interview with Chancellor Scholz?
I've made it pretty clear.
Good. AMH, happy birthday. Thank you. TK went missing Friday night. Tom, where were you? Birthday celebration. What happened to you?
It's too emotional that it's her birthday. You know, I just.
Literally, you're the schedule police today, John.
I was scheduling
John,
Tom on Friday. Tom got the message. I got the reply. The response said, "We are bonding over medical bills, and I can't make it."
No, John, it was a bit of a domestic.
Was it a bit of a domestic?
It was a bit of a domestic.
Tom Keane, I hear that your Bemelmans over at the Carlisle has gone downhill in a big.
I got to be careful what I say.
Big way.
I got to be careful.
In a massive way.
Got to be careful. There's a new place downtown.
What's the new place?
I don't know, south of 59th Street. I'm in research.
That's downtown?
That's downtown.
South of 59th, okay.
It's like in the 50s, Murray Hill.
Nice. You going to tell me about it?
Yeah, I don't know. I'm doing research, seriously.
All right. I'll get to the market, Tom. Futures down 0.2 on the S&P, on the Nasdaq 100 down a little more than 0.1%. Lisa wants to talk about those bond yields up a single basis point on 10s to 192. Bramo publishing again over the weekend with a fantastic piece. Yeah. Brilliant piece. Find it on Bloomberg.com and on the Bloomberg Terminal 2. The global real yield tantrum of 22. Lisa, it's here.
What's the tantrum part?
The tantrum is that you really don't have any kind of compass when it comes to the market readout. And frankly, exactly what you guys were talking about with the negative yielding pool of bonds. How do we look at a new regime where there isn't that weight on yields? Has the U.S. market accurately priced in the global tightening cycle? And I don't know that anyone can predict the magnifying effect of all of the banks working in unison.
Are you committed to publishing every Sunday now?
Yeah, unless I'm on vacation.
This is a commitment unless you're on vacation. Okay. It's a great piece. Thanks. Find it on the Bloomberg Terminal and on Bloomberg.com. And I have no doubt that Lisa's going to push that out through the day on Twitter as well. From New York City for our audience
movie rights
worldwide.
Oh, come on.
As we kick off the trading week, this is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Coming off the back of the biggest week of gains on the S&P 500. For the year so far, futures this morning, and good morning to you, slightly negative, a little more than 1/10 of 1% on the S&P. On the NASDAQ right now, down 1/10. On the Russell, the small caps, they underperform, down 0.5 of 1%. Equities up last week, even with another monster move at the front end of the yield curve. So let's talk about that. Switch up the board and get to 2s, 10s, and 30s and sit on 2s. Every single week of the year so far, your 2-year yield is higher. This morning, 130. Through 120, through 130, and on 10s through 190, so big move there as well. This is not just a US story now, it's gone global. It includes Europe, and as Deutsche Bank points out, as more European debt escapes negative yields, maybe there's even more pressure on treasuries to come, considering this has been an anchor for the global debt market for so long. So let's talk about the pool of negative debt worldwide and get to the chart. This is the chart. Worldwide, the stockpile of negative yielding debt on the Bloomberg Ag. Tom, this has moved so much, so quickly. Back in 2020, it was pushing 20 trillion. Now it's dropped below 5. And a story on the Bloomberg pointing out that in just 2 days, we wiped $3 trillion off that amount, just like that. I'd go to the front end of the yield curve in Italy for some of that story. Look at the move there. We were negative last week to start the week in negative territory. We're now right away heading to 50, Tom. It's been a big move on the Italian debt market and worldwide for that matter.